All right, guys, I am talking to Mike, the dividend guy. We are breaking down his $607,328 portfolio. He has 7 main holdings. We're going to start with number 1. That is Apple Inc. He has $52,000 in it. That's 9% of your portfolio. You bought it at an average price of $26.60. Why did you buy Apple? I think I know why. I think we all know why, but tell us anyways.
Well, actually, I might surprise you because I first bought it in 2014, not too long after it started to pay a dividend, because I focus on dividend growth. And of course, the company had a great profile back then, but it was still considered as a one-trick pony, right? Just selling iPhones back then, and that was pretty much it. So the P ratio was super low, and then it started to pay dividend, and I looked at the cash flow ability here, and I thought, well, that's an interesting position to have in my portfolio. And over time, it just blew out, of course. And the reason why I have it now, because I bought it a few times later on. I quit my job in 2017, so got my pension plan, added a little bit more on Apple at that point. And today, what I really like about that company is because it generates so much cash flow with the iPhone, it has this ability to not even come first in the market. And they did that plenty of time. They can study a market, they can look at new products, and then when they come in, they have full power in terms of cash flow to deploy and actually craft something of high quality. So whenever people say Apple is dead, I've been reading those articles for the past 10 years, but they have this culture of knowing when to enter in a market and create new businesses. And then just their service segment now is a whole business by itself, even though the iPhone is still the main driver here.
Okay, you said a couple interesting things there. So yeah, the ability to come into a market with all that cash flow, take something that's working, make it way better, do it the Apple way. That's interesting. Also with Apple is I don't think they'll ever be dead. People in the Apple ecosystem are there for life. I think anyone who has an iPhone, they've had it for the last 5 years. I don't see how they would transfer off of that. Apple doesn't make it easy to use non-Apple products and Apple devices. So once you're in their ecosystem, they kind of lock you in. So I think they have that kind of a bit. It's not a guarantee. Nothing's a guarantee, but they have that going for them as well. It's not like an Android or a Google ecosystem where you can kind of float between them a lot easier. With Apple, you're locked in. I think obviously that's an intentional move. One other thing, you said you retire. How old are you? You're not old though. You look fairly young.
Oh, I didn't retire. It's just that I quit my job, which is a bit of a different thing.
Yeah.
So I worked in the financial industry for 13 years. And then in 2016, I decided to take a sabbatical year and drove in an RV with my 3 kids and my wife all the way down to Costa Rica. So we spent a full year together, and I had my online business on the side. And then when I came back, I'm like, yeah, well, as a private banker, I can help like a few hundred clients. Now with this online business, I can help thousands of people to invest. So I decided to quit my job, and then I receive the commuted value of my pension plan. So I still consider myself as kind of like a retiree in a sense where I do whatever I want, whenever I want, but I do work for money. So I could not stop working, but I don't really see myself stop working anyways. So it's kind of like a different type of lifestyle where I work 365 days a year, but I'm also on vacation just as much. So I can take several weeks of vacation because I just travel with my laptop, and this is all I need to run the business. So it's kind of like a different approach to kind of like retirement, just enjoying life actually instead.
That's pretty awesome. Another thing, we were talking off camera. You were telling me how you're not a dividend investor, right? I do a lot of covered call content. I do a lot of even people who work off regular dividends. They'll still be looking for a 5% yield. All right, I've been talking to a lot of people. When we're talking and kind of think of you as a value investor, you find stock that you think are undervalued, invest in them because you know they're going to go up. Like Apple was a really good one, up 2, 3, 4-fold. But you use the dividend as an indicator on the overall value. Can you kind of, in layman's terms, people who aren't used to this, just kind of walk through that process? So, and in layman's terms,
yeah. So I kind of like the way you frame it, because it is not how I invest. I'm not a value investor in the sense that, yes, we all love to buy a stock that is cheap, right? And we have to have a good deal. But in my perception, your assessment of the stock value today is as good as mine, and it's as good as a crystal ball. And I could ask my dog what they think about the valuation, and that will be about the same thing. if you look at analysts, they will like have their 12-month target price like up 30% to down 30% for the same stock for the next 12 months. So instead, I use what I call the dividend triangle, which is the foundation of my analysis. So when you, as an investor, when you buy a stock, what do you want from that company? You want a company that has the ability to grow their sales, right? Because without any sales, you don't really have a company. So I'm tracking the revenue growth. Then once you make sales, you also want that company to make profit, because what's a company just burning cash forever? I mean, at one point it has to generate profit. So I'm tracking the earnings per share for that reason. So now that I found a business generating good sales and making good profit year over year, it's only normal that that business will share the wealth with their shareholders. So paying a dividend. And I want that company to be able to increase the dividend payment every single year for two reasons. The first one is a very good indicator that the business is healthy, because for the business, the dividend is literally just cash given to the investor. So they don't get nothing out of it. It's like a payment. It's like you're giving your children like a small allocation every week. I mean, if you lose your job, probably that's going to be the first thing that you're going to cut in your budget. So for the business grows sales, it grows profit, it grows the dividend. And then every year, if they are able to do that, that also shows a lot of confidence from management. So basically, the CEO and his team are telling you, don't worry, Gary, we have it under control. We have a good plan to grow the business. And this is why we are able to grow the dividend. So when the company is able to be a match on those three things, then I'm going to dig further and look into understanding the business model and everything. When it comes down to the price, I don't really care. If I have money, I want to invest it today. I never have dry powder. I'm always 100% invested. And the point is always the right moment to invest is always today. So if I
It's
find a
interesting.
stock that I really like, well, if I have money, I'm going to buy it right away. So if I don't, well, it's going to be sitting on my buy list for whenever I have to do a rebalancement of my portfolio, or I have to sell a company that does not match that dividend triangle anymore. Because unfortunately, we all want to keep our stocks forever. But from time to time, companies changes, environment changes, the economy, the rules, laws. So you'll find companies that eventually become mature. They are struggling to grow their sales, then they're struggling to make profit, and eventually the dividend growth slows down or stops completely. So in those cases, I will sell, and then I will go on to my next item on my buy list, for example.
I don't. I have a bunch of questions here. First off, we're almost aligned. I think the difference between me and you is I won't buy it if I have the money available, even if it meets most of the criteria, if the price isn't at the right entry point. Because my margin of safety for me is always my buy-in price. So if I can't get it at that right buy-in price, I'll just be like, oh, well, I'll just wait. So I think I do a lot more waiting than you do, right?
Mm-hmm.
So that's the difference. But your criteria of what is a good stock to buy, we're basically the same there. I think it's just that pulling the trigger for what we pull the trigger is a little bit different there. Are you trying to, because you don't own ETFs, right? You're just all
Nope.
single ticker, right? And I
Yeah.
get it because, in the hierarchy of sort of this type of investing, and you come from finance, it would go, if you know nothing, you start with mutual funds. Then you get more comfortable and you realize, wait a second, why am I paying 2%? Then you switch into DIY investing and you get into ETFs, right? An index fund on an ETF. And then when you do it for long enough, you eventually start going, wait a second, I understand this. And you start picking specific stocks that can probably outperform the S&P 500 or the same as, but without paying that management fee that you pay. So there's sort of steps as you get more comfortable, but ETFs are fine, guys. If you're an investor or if you want to be hands off,
Totally.
it's fine. Yeah. Okay, so are you beating the S&P? Are you beating like a 10% average return yearly on your stock picks? Because we're going through 7 today. I'm sure you have other ones, but overall, is your portfolio up typically 10 or more percent a year?
Yeah. So the I actually publish my pension plan portfolio because it's in the locked in RSP Lira account, so I cannot add capital to this one. So since the end of 2017 to this day, every month on the Dividend Guy blog, I publish that portfolio. And it's a good example, good representative of my strategy because all my other portfolios like this. And my benchmark is 50% VFV because I have to consider, yes, tracking the S&P 500, but on top of that, the currency factor. And the other 50% is the Canadian market because my portfolio is like 50% Canadian, 50% US. And to
Yeah.
this date, I average a little bit over 14% annualized growth rate since 2017. So I beat that benchmark by about 1% annualized growth rate. So it's a good thing, but my goal is not necessarily, of course, we all love to beat the market, but the goal
Yeah.
here is not there. And this is not why I invest in stocks instead of ETF. It's just because I want to be in full control of my portfolio. That increases my level of conviction in my portfolio and my
Yeah.
strategy. If I have an ETF, which is great, the problem is, as you said, if I'm interested in digging further and I look at all the holdings, all the companies one by one, I will find companies I don't want to own, but I'm stuck with that. So I don't want to invest in ETF for that reason. However, if I didn't have the time, the knowledge, and the interest into reading financial statements and digging a little bit further, well, then the ETF would be my easy route because that's the best way to invest if you want to save time and you want to have like a professionally managed portfolio that is not too expensive.
Um, for myself is I like to go back and forth and compare our strategies. The reason why I do ETFs, I basically just own VFV. That's the only ETF I really own, and it's a pretty sizable portion, at least of my TFSA. It's a pretty good portion of my TFSA. It's like 25 to 30%. Is I I think it's more just paranoia. I like knowing that there's something in my portfolio that nothing can happen to. It's just that. It's just like
Yeah.
hedging against vol. Like it's just like I just know it's like no matter what I do, because I do a lot of crazy stuff. I'm like, at least I have this thing there that like no matter what I do, will never. I think that's all it is for me. It's like a peace of mind thing because I am picking individual stocks a lot, and that's where almost my portfolio is. Um, I had a question about that, but I forgot what it is. But so your portfolio then is single stocks. You do beat the market all the time. Also, oh yeah, here's what I want to do. Guys, I have the link to his YouTube in the description and first pin comment. I want you to go through the link. As he mentioned, you can see everything that he's talking about here through a little different links on his socials. There's Dividend Stocks, rock.com. You can go check that out. But that's all that is through the link. So you can only see it if you click the link in the description and first pin comment. Okay, now here's a thing I want to talk about. You said you own a business, you run a business, you came from finance. Is your business related to finance? Is that what your business in that same area?
100%. So my business is Dividend Stocks Rock. That's a membership. That's a membership website where we help investor invest with more conviction so they can enjoy their retirement. So we provide all the tools like private webinars where I do Q&A, a live Q&A for like 2 hours every month. We have a way that you can build your portfolio, get an analysis as well. We have a team of analysts that covers over 1,000 stocks, and every quarter, if it's the company that pays a dividend, we will review the quarterly earning for you. So you won't have to go through the press release and read the investor's presentation. We're going to tell you, Gary, Pepsi had a terrific quarter. It's a great company. All things are good. Or maybe, Gary, you want to take a look at this one because they had some bad news. The revenues are going down. They're losing money. We don't think
Nice.
the dividend is safe anymore. So just raising flags and telling you where it's okay. We have stock screeners, stock analysis, and all that stuff. So that's the biggest part of my business. And the second part is retirement loop. So retirement loop, we can see like both right,
Oh
right
yeah,
behind
yeah,
me.
yeah. Yeah, yeah.
So what I discovered after helping DIY investors to build their portfolio and get that information is the next step is those guys will retire, right? And when they retire, they need a plan. They need to know how to withdraw that money, those mechanics, how to optimize for taxes, CPP, OAS, when you take them, what's the pros, what's the cons. But then they manage their portfolio by themselves. They don't want to deal with a financial advisor because unfortunately, many financial advisors are going to say, hey, Gary, yeah, come here. I'm going to do your plan for you. But first, let's transfer all your portfolio here. And then we're going to talk about retirement, right?
Yeah.
So there are some fee-only, fee-based financial planner that are great as well, but it's not always easy to find and to trust. So I decided to open this new membership that we started in December of last year. So we now have close to 600 members there, where we help them build their portfolio. So it's kind of like a done with you. So we don't provide the financial advice, but we're going to provide all the tools you need to know how much would be your retirement budget, how can you save tax on that, and then if you have questions about insurance, about estate planning, about anything else that is related to retirement, well, we have retirement coaches. We are there for you, and we have that community where people can ask questions among themselves. Because I mean, something super like mechanical as, oh, I need to transfer my RSP into a RIF next year. How does that work? Like, what are
Yeah.
the, like, we all get the concept that we're going to withdraw money from the RIF, but then, like, when do I set the payment? Like, which percentage is this? And all that stuff. Well, then we have members at Retirement Loop that went through all of those hoops, and then they can share that with the community. So it's a great place for people in transition into retirement to find the answers they're looking for, and not paying like those $4,000 or $5,000 financial plans, or getting harassed by a financial advisor that just is after your portfolio and not really after your retirement plan.
Yeah, that's a great resource. We're speaking of retirement though. What are you planning to do with your portfolio in retirement then? Are you going to
I'm going
convert
to
it
keep
into some?
exactly the same strategy. And the difference, though, because of course, if I'm 100% invested and I have a bad year in the stock market, that's going to suck, right? I don't want to
Mhm.
withdraw like 4 or 5% of my portfolio. And on top of that being down 10%, it's going to drown the drain very fast. So the only difference is I'm going to have a cash wedge. So the cash wedge will be determined between the gap between how much my portfolio pays in dividend and how much I need to withdraw from it. So quick example, imagine I have $1 million. I generate like $20,000 in dividend because I focus on low yield, high growth stocks. I want to withdraw 50. So the gap is 30 grand. So what I will do is that I will have a cash wedge of $90,000. So 3 years of bad market as a protection. Why
That's
three
smart.
years? Well, on average, most bear market will take about 18 to 24 months to recover. We can think of like the 2022, 2018. 2020 was like just a snap, but I mean, those are like small bears, like the nice like teddy bears market that are just earning your portfolio but don't do much. But sometimes we're going to have like crisis like 2008 or the tech bubble of 2000, and those took about 4 to 5 years to recover. So I decided to go to three, because I mean, of course, if you can put five if you want, but that's a lot of money into a cash account, like a high interest rate saving rates, a high interest savings account or money market fund that will not generate much money. So I don't want
Yeah.
to be too protective. So I think 3 years is more than enough to just withdraw money from the cash reserve while the market is down. And then eventually I just see my portfolio as my own investment firm. So I'm the boss. I decide how much I withdraw. I don't let the investment firm say you're getting like 5.8% yield. No. If I want to take like 5%, I'm going to take the dividend plus I'm going to sell some shares, and over time I ensure to have a higher total return, which means I'll be able to spend more money down the road, and the cash reserve will protect me from any down markets.
I want to talk more about that cash reserve. I think you're the first person who's talked to me about that. Um, I do videos on retirement a lot. I think about it enough, but probably not as in depth as I probably should, just because I'm not really at that age right now. I'm 39. Like I'm getting close. I'm working towards an early retirement. My age I'm trying to retire by is like 45 ish, I'm gonna well, I'm the same. I won't actually retire. I'm gonna keep working the exact amount of
Yeah,
hours, but
just
technically
having
start.
fun, right?
Yeah, yeah, but like I'm technically retired right now. I keep telling people like I'm only doing stuff I like right now. I just like so it's like I'm sort of there right now, but I might just like completely step back and just travel more around 45. But so you said like putting it in like a high interest saving or something. Have you looked at possibly putting it into like a cash.to ETF that gives you a slightly better long term payout than a high interest savings? So like sometimes you get those decent deals for like the first 3 months, but it drops down. What about like in an ETF that just is basically cash that just gives you 4 or 5% every single month? Have you thought about that, or is you that off the table?
No, actually, I mean, I haven't given that much thought because, of course, I'm not ready to be there either. But definitely any, like when I say like high interest rate savings accounts or stuff
All of
like that,
those.
that could be an ETF. Yeah,
Yeah, yeah, okay.
it's the purpose of that cash reserve is more, you want something that is liquid because of course you never know when the market's going to crash, so you need to have access to that money. You want to maximize the yield, but you want to minimize the volatility. So if I put like $90,000, like in my example, I don't want to see that $90,000 going down to 88. Like that's not the
Yeah,
purpose. I already have
yeah,
a portfolio for that. So anything that would pay me a good yield and ensure me that the 90 will always stay at 90, well, that
yeah,
would be the purpose of I mean, some people would opt for like a bond or a GIC ladder of like 3 years. That would work as well. A little bit less flexible. Maybe
yeah.
you can get a better yield. I mean, it depends on the market, right?
I use the reason why I say cash, I'm not promoting it or anything. It's just I use cash for just when I'm holding cash. It's
Yeah,
cash.to from Global X Investment. It's at $50 and it goes between like $50.01 and $50.02. Like that's the fluctuation. And it just
that's good.
changes.
That
Right.
would fit my definition.
Yeah, yeah. So, and I don't even know what the yield is. I'm not too worried about that. It gives some level of a yield. And it's instead of just holding cash, I hold cash ETF instead.
Yeah.
So that's kind of like something I do. So I use that as an emergency fund. But now that you sort of mentioned that kind of buffer, I like that. I like that cash wedge, as you call it. 3 years is technically an emergency fund. Same thing I have. I have I have same as you, like 90, $100,000 just as like a wedge. But right now in my life, it's more of a wedge between if everything falls apart, I have money to survive while I figure out the next steps, right? That's what I use it as. But yeah, but I guess the same thing would apply in retirement. Okay, that was number one. That was Apple, guys. So we were all over the place.
We're in for
By the
8 hours of
by the way,
for
this is
this
how
show.
this is how the podcast works. I start with talking about stock and it goes in 80 different directions, and then we
I
come
love it.
back to what we're actually trying to talk about. Okay, number two. All right, and I'm waiting for you to correct me on the name of this. It's number two. It's Alimentation Couchetard. You have $37,000 in this. Is 6% of your portfolio. You bought it at 37.53. I'm assuming that's a good buy-in price. I actually don't know what's that. Ticker is ADT.TO. Why'd you buy it? What kind of company is this? You're not the first person who's mentioned this one to me. So yeah, what is it?
You're
Yeah.
probably more familiar with Circle K.
Oh yeah. Yeah, okay.
Well,
Yeah.
they own
That's
Circle K, so that's the convenience store. Yeah,
they own a bunch of don't they own like a bunch
uh-huh.
of convenience stores? Yeah, that's
They
why I've
do.
heard of them.
They're
Yeah.
actually the second largest convenience store company behind 7-Eleven. And there was that whole saga earlier this year. They tried to acquire 7-Eleven because they're actually making more profit than them. So they have less convenience stores, but they're like bigger in that regard. I really like this company. I mean, of course, it's coming from my neighborhood. I mean, Laval, Quebec. So it's Alimentation Couchetard, but yeah, Circle K for most people, it's gonna sounds a lot better. So they ran into some difficulties over the past 2 years. It's a really not a super cyclical stock, but they go with the economy. So it's like halfway consumer staples, halfway consumer discretionary. I mean, they're selling gasoline and then uh chips and snacks and alcohol and cigarettes in their convenience stores. Their main growth vectors is growing by acquisition. So I
Uh,
had Alimentation Couchetard forever. Really love the company because they are incredibly good at making those deals. So whenever it doesn't make any sense, they just walk out. So they tried to buy 7-Eleven. It's not working. At one point, they're not going to overpay. They're just going to walk out the deal. They tried to acquire Casey stores about 12, 13 years ago. Same story there. So they are very disciplined in their approach. And of course, right now, as the economy is slowing down, so they're selling a little bit less fuel. The revenues are like stagnating. The earnings are slowing down a little bit. So it's a rough time for them. But they have a very strong management team and they want to grow organically and by acquisition in the future. So for the organic part, they want to introduce more fresh produce and meals that are already prepared, like cooked meals, into their convenience stores to increase the foot traffic and increase their sales at that time as well.
is their price down a lot right now? Or is it
It's about like down 15% from its peak. It's been since the beginning of 2024 that the stock price is going nowhere, actually. So it's been almost 2 years now that the price doesn't go where. But before that, it kind of like doubled in value. So like the average price that I have is $37. The current price right now it's 74. So it's just that sometimes some stocks have to take a break. I mean, even Apple right now is down year to date. So
I
it's
don't
cannot
care when
always go up, right?
if it's a valuable company, I don't even care when the stock is down. I just try to figure out, is that a buying opportunity? That's what I was asking. Like if it was low enough, I go, hey, maybe I should enter right now. Um, but you got in at 37.53. You're at 74. What year did you buy in? Oh, you've been buying it forever. You
uh,
said, right?
for a few times actually, yeah. So the oldest position, actually, funny story, it was one of my first stock that I bought back in 2003. Unfortunately, I sold all my stocks to buy a house in 2006, but
Yeah.
Alimentation Couchetard was already part of my portfolio back then. And then I started a bigger position in 2017, bought more in 2021 when they wanted to buy Carrefour, which is the largest grocery store in Europe. It's a French company. But then the French government said no. And then the stock price dropped by like 10%. And then I jumped in and I increased my position at that time.
Why the government say no? They're like, don't have a monopoly or something. They just thought that.
Yeah, they wanted to protect because since it's the largest grocery store in France, but also across Europe, so they wanted to protect like their access to food, I guess, type of thing. So it would be like the Canada saying no to the acquisition of like Loblaws. That kind of
Yeah.
makes sense. I mean, we don't necessarily want another country to own Loblaws here, right? So
Yeah. Yeah, okay. That makes sense. Okay, that's an interesting one. I'm gonna add that just to my watch list because not just you, that's been mentioned to me a few times. Number three, let's move to National Bank, ticker NA, $36,000, 6% of your portfolio. You bought in at 79.91. Why this one? Yeah, just explain.
I'm totally biased. I worked for National Bank for 13 years before quitting
Uh,
the job.
yeah. There you go.
I
There
mean,
you go.
jokes aside, if you look at the metrics for Canadian banks, National Bank has been one of the best performing over the past 5 and 10 years in terms of revenue growth, earnings growth, and dividend growth. They show a low payout ratio as well. So they are mostly based in Quebec for their banking operation, but half of their business model is not about banking, but rather about wealth management. I used to work for private banking 1859 as a private banker over there. So they have like a very interesting model where they serve people with a high net worth, but they also build their pipeline by serving all business owners before they have a lot of cash. So if you have a thriving business with a revenue over like 3 and 5 million, eventually you're going to sell and then you're going to cash out a couple of millions, right? Or maybe 10 millions. But in the meantime, you probably have a salary of like 75K or 100K, like maybe a couple of $100,000 in your bank account as an investment, but most of your cash is in the business. So what they do is that they give you the high network service right away. And then when you sell, well, you just think to go there. They're very strong with capital markets as well. That is like market making, build like creating products, managing ETFs, and so on. And they recently acquired Canadian Western Bank to expand their exposure in Western Canada. They also have exposure to the US and international market with Cambodia, which is a similar model to National Bank in the sense that it's the largest bank in Cambodia with ABA Bank, and they operate it similar to way in the sense that they're like a super regional bank where they own a good part of the market and they start to grow that way. So I like the fact that they're like smaller and more agile than the other big banks. And yeah, so that's been in my portfolio forever, of course.
Yeah.
But from time to time, I actually trim that position. Same thing with Apple and Couchetard when they go too high. I trim a little bit and then I buy something else. So there you go.
Did you start acquiring it when you started working there? So you've had it for
Yes.
that long? So this would be
Yeah.
your oldest position, right? Would it not?
Yeah.
National Bank?
Yeah. I was like literally, I started working in 2003 at National Bank. 3 months, like my boss met with me 3 months after, and he's like, "You're officially like an employee after 3 months. You're allowed to put like to use our employers program with the stock options, and not stock options, but you can buy stocks and you get a rebate." So he told me up front, "You're gonna put 8% of your salary into that, and there you're set." So I
Yeah.
started this way, and I actually was a pretty good advice, not just to buy national bank, but I mean, I was in my early 20s and
Yeah,
we
that's really good
already
advice.
forced myself to pay myself first, right? So it was taken out of my paycheck. I could not even have it in my bank account right away. So it was already deposited there, was part of like my RSP contribution and so on. So that was just a great start in the investing world.
Your manager told you that when you got hired?
Yeah.
What a
Yeah.
good guy. That's a really
Yeah.
or gal or whoever it was. That's really good advice. So would that just be all your banking exposure? Because you don't really bother with any other banks, or do you ever?
No, I do have Royal Bank in my portfolio for another 3%, for two reasons. I mean, it's one of the largest Canadian bank, but also it has a similar business model where they have 50% of their revenue coming from classic banking activities, the savings and loans, the mortgages, and the
Uh,
other half is wealth management, insurance, and capital markets. So a little bit similar to National Bank in terms of diversification. I did not want to have a pure bank play that just focus a lot more on commercial banking and mortgages, but I like the investment part of that and the capital markets as well. So that's why I have both in my portfolio.
all right. So I'll make number three National Bank plus RBC, a little bit of RBC in there as
You,
well.
you can do that, yeah.
Uh, I want to talk about number four because this is an interesting one. Okay, this is Microsoft, and that's MSFT, $32,000, 5.5% of your portfolio. You bought it at, this is the number, $75.10. You're talking about this before. This is the interesting part because when you bought it, everyone's saying it's overvalued. Let's talk about that. Your mind frame, everything about it. Because this is now. Remember we talked about before where we differ. I wait for the price to drop, and then
Yeah.
I would have missed Microsoft. You, with your investing habits, didn't because of your structure. This is where you're actually overperforming here. And that's why, it works for me, but I would have missed this opportunity. Can just talk about that a
Yeah.
little
I
bit?
mean, each strategy will force you to miss some good stock anyways,
Yes.
right?
Yeah, yeah. That's 100%.
So
Yeah.
back in 2017, as I told you, I got $108,000 for my pension plan. And it was September of 2017. The market was trading at a all-time high. Everybody was saying like we're imminently going to have a crash anytime soon now. So I got that $100,000 and I said, well, I need to invest it right away. So I started using the dividend triangle, pulling out the research, finding companies that I love back then. And within a month, I invested almost all of it. And the only
Uh,
reason why I did not have enough time actually to invest the full $100,000 in the first month, it was because I was also working on building DSR and growing dividend stocks rock at the same time. But anyways, so I see Microsoft, the revenues are growing, the earnings per share is growing, the dividend is growing. So the dividend triangle, all the boxes are ticked. Back then, I really liked because they were in that transition a few years before. They instead of selling Windows every like new version, like a launch, and same thing with Office, they moved to a subscription based model,
yeah.
generating a more stable cash flow and predictable cash flow going forward. So I really like that part. And they were they were starting their cloud business as well. That was another very promising growth vector. Obviously, today it's really easy to say, but back then it was already there. And the fun part is, I was reading articles on Seeking Alpha, and there was like Fast Graph, also like well known, and they're doing an amazing job in the US though. But they were all saying like $75, it's trading at a all-time high. It never been that high. So wait until it goes to like 55, $60. That would be the fair valuation to go to your point. Like that would be the good entry point. Well, I mean, you can still wait today. Maybe we're gonna have a split 10 for 1, and then you're gonna be able to grab it at $50. But that's the
Yeah.
only thing, right?
Yeah.
The company continued to skyrocket it back then, and for the fun story, I invested $108,000 in September of 2017. In 2018, between July and December, the market went down by 20% from the peak value. So it was a small bear market. At no time, even in December of 2018, my portfolio showed a value under $108,000. I think the lowest value I got there was maybe 115 or 120. But even if I invested all my money at the all-time high market, where it was like a huge bull run between 2009 and 2017, like was almost uninterrupted, And there you go. Even 2018, 2020, 2022 never got that pension plan going on there and actually showed great profit throughout the entire time, even though it was all invested at overpriced stocks.
Um, that's such a good buy, and that's a good lesson, guys. And you mentioned something interesting. No matter what, when we first started talking, your investment strategy is, you're gonna miss opportunities no matter what.
Yeah.
Like when you were talking about Alimentation Couchetard. Hey, what is it? Is it Couchetard? What is that? How you say it?
Couchetard. It's just
Couchetard.
Couchetard. Forget about the D.
Okay, Couchetard. Okay.
There you go. Perfect.
But there was a period when I was looking at Dollaramas and stuff like that, because when you said Circle K, I was looking at, and I was looking aggressively, and I thought, okay, it meets everything I'm looking for. I just need the price to drop a bit more. And now they're just like all
Never happened, right?
No, it never happened. And I missed it. And it's just something I've learned to live with a little bit better, being like, hey, that just happens. But it is what it is. But it's just the amount of time you spend researching. It's just like, ah. And then it's like, okay, and I did nothing with it. But hey, if it ever drops, no, it won't. It won't even drop down to where the proper valuation now that I need it. But I missed that opportunity. All right, now let's move on to number 5. Brooksfield BN, you have 31,500, 5.4%, $33.26 is your average share price. How much you bought it for, or your average share price. Explain what is Brooksfield, why'd you buy it, yada, yada, yada.
Brookfield is probably one of the most complex company in my portfolio because it's an asset heavy manager. So in asset management, you have like 2 types of asset manager, asset light and asset heavy. Asset light, you can think of like companies like BlackRock, for example, where you like the ETF side. You give them their money, they charge you a fee to manage that money, and there you go. It's not BlackRock's money that is being invested. And then I know that they have some other projects, but I'm just talking about the ETF side there. They just pool the money, create the fund, invest, charge a fee, end of the story. So sticky business model, recurring business, all good. So Brookfield does that, but it also uses its own capital to invest into their own projects. And the thing is, they're everywhere. So they have a lot of real estate. So we're talking like large buildings in major cities. They do a lot of credit. They do a lot of insurance, and they are known to have stake into Brookfield Infrastructure, in Brookfield Renewables. So they have all those tentacles everywhere. So they invest in bridges, in power plants, solar plants, wind farms, highways, name it. They're pretty much everywhere. And one of their main characteristic here is they invest into what I would call something that requests patient capital. So when you invest in a bridge or you invest in railroads, you want this asset is going to generate cash flow for more than 50 years. So, but unfortunately, it's not liquid. You cannot sell a railroad or a port or a data center. It's not that easy. So there's a thing. Your money's kind of like locked in there for a while. And what they're really good at it is to buy an asset, improve the profitability, and then sell it, which is called asset recycling. So when they sell, they make a part of that profit in their own pockets because they're asset heavy. So it creates a whole lot of trouble when you're trying to make your way through financial statements, though, because you have a lot of amortization, you have a lot of companies they own that you cannot dig into. So it's probably one of their biggest risks, in a sense that if you don't trust management and they do something wrong, well, I'm going to take a big beating on this one, that's for sure, because it's almost impossible to track everything. It's not like Alimentation Couchetard. I mean, they have like 15,000 stores. They sell stuff there. It goes in, it goes out. It's easy to track down like the business model. There, it's kind of like blurry. So from place to place, because they're like, oh yeah, we own that power plants over there. Okay, so what about it? Well, that's pretty much the information you're going to get from it. So you don't know like the revenue and the earnings per asset.
Other than being a solid company, it sounds like a pain in the ass then.
It is.
So why did you buy it? Because sometimes I look at that as a buying factor of, is this going to be a pain in the ass? I sold Tesla, not because there's anything wrong with Tesla. It was being a pain in my ass. I didn't like waking up to market news of the CEO doing something and affecting stock price. That was just annoying for me. And I was like, I don't want to have to deal with this. So I sold. this just seems like a pain in the ass to track everything because like you said, their business model. Why did you buy it then?
That's a totally fair point. The one of the advantage of my business is I get to spend my entire day watching the market anyways. And by watching the
Yeah.
market, I'm like, not I don't really go after the news because I don't really care about that. I consider that noise, but
Yeah,
I
same.
get to do a lot of deep dive analysis. I do a lot of follow-ups, and I like that stuff. Like, it's kind of funny because my of course Couchetard is like quite popular in Quebec. There's like convenience stores everywhere. My children have shares of Couchetard, but whenever they're about to announce their earnings report, I'm all excited at home. I'm like, yeah, it's tonight. It's after the market. Like, and they're just looking at it. It's like, Dad, I don't care. Just
Yeah.
like, just go do your stuff. So I love digging into those things for Brookfield. So I don't mind. And it also comes with, if it was a recent business, like maybe 5 or 10 years, I could understand that the risk is even larger. But Brookfield has been around forever. It's like 100 years old. So
Yeah.
the thing that they have a long history and there's that buildup, you see that there's a culture and an expertise that was built throughout time. So while yes, it's true that you can cook financial statements, you cannot really cook a distribution, right? So if they're paying dividends across the board for several years, well, that you cannot fake. It's real money getting out of their bank account. And we went through multiple financial crises and bear markets. And usually when you have like a Ponzi scheme or anything that is fraudulent, it explodes when the market goes sideways. It's the best test that you can have for any type of business or product is it able to maintain the distribution or the dividend throughout a very challenging market? And if they are, well, then increase also the level of conviction. So I would not necessarily suggest people to dive into this one if they're like it's the first company that they will analyze because they're not going to understand enough. But if your passion for investment grows, this is the type of companies that is actually challenging. So it's kind of like I like the pain, if you if you want to put it that way.
Yeah, yeah, that's what it sounds like. But I do like the fact that it's a solid company that, and you said it's been around forever. They've survived every type of market condition. It's having this part of your portfolio, I feel like is other than, it's a pain looking at all the like data, sorting through that. But I think there's some peace of mind with this one. They're not going anywhere in 20 years. Like there's that. You mentioned something about news being market noise. Speak about news a bit because I feel, and we're talking to, I think veteran investors know this, but newer investors are heavily influenced by day to day news, and it starts dictating selling opportunities. Not so
Mhm.
much buying, it's so much like sometimes buying too as well. Like when something gets pumped and they're like, oh, I'll buy, but they're just buying at all time highs. And then they start selling when panic sets in and they're selling at something that might just be a temporary dip or the company is fine. Talk about how you view news. How do you use news if you do use it at all in any sort of way? Do you listen to the news? Are you looking at Bean and Bloomberg every day to see what's happening and who said what? Is any of that on your radar, or are you just in financial statements?
Not at all. I don't look at any news. And of course, that's the interesting part is even if you cut yourself out of like the news cycle, like people are going to talk about it to you. So I never miss something because somebody else is like, of course, we have almost 4,000, we have a little bit more than 4,000 members at Dividend Stocks Rock. So whenever there's a big news and the stock that goes down 10%, I receive emails. So I'm already aware of it anyway. But here's the thing, when I invest, I want to invest for the next 30 years. Like in an ideal world, I would just stick to my guns, keep the same stocks forever. Unfortunately, it doesn't happen this way because everything changes over time. But for many, like most of my biggest winners, and we just discussed some of my biggest holdings, I've been holding them forever as well. And that's the
Yeah.
whole point. So is a small news is going to change my entire view? Not really. And for the story, I'm pretty sure that a lot of people now know about Broadcom, which is one of like the largest company now, doing semiconductors, growing by acquisitions, and they're known right now because their stock is skyrocketing due to their implication into AI. So they're selling a lot of stuff that is improving AI to compute faster. Back in 2018, they made an acquisition, and they do that all the time. But the market didn't like that acquisition. They thought it's not a perfect fit. It's a lot of billions spent in the wrong way. The stock dropped by more than 10%. Do you really think we care today? I mean, the stock between 2018 and today is like up more than 1,000%. So that 10% in a day doesn't matter. So I'm a big fan of Peter Lynch's quote of know what you own and why you own it. And if you really understand the business model and the reason why you have invested in a stock, or if you invest in ETF, it's the same thing. You need to understand the strategy and what evolves around that strategy as well. Once you know that, you don't need to read the news, because it's literally noise. It's just the the media will always try to convince you that today is really important, as you mentioned, that this week or this month or this quarter. But really, we don't care, because I mean, even a quarter, you're going to invest for the next 50 years of your life. What's 3 months? Literally, what it is. It's not even a good percentage of the next 50 years. So
We both come from like a finance background. I'm finance marketing. You're actually finance. And I view it as the news needs something to talk about every single day. So they
yeah,
just got to report on stuff. Oh, the NASDAQ went up 0.01%. Oh, the market dropped 2%. I'm like, why do we even care? Like, I always think, I'm like, I just don't care. Like, none of this matters. So like, I've never made a video about that kind of stuff, because I know it doesn't matter, because here's what's really happening. They need to report on something. They need to sell ad revenue. They need to make ad revenue. They need their sponsors. If they don't constantly talk about stuff, they can't sell you the product. Like, it's just they're running a business. That's all it is, right? And it's easy to get like pumped up by all that stuff, but it's completely off my radar. I don't listen to the news at all when it comes to the investing space. I don't watch. I have nothing against these channels like Bean and Bloomberg. I don't go on Yahoo Finance obsessively and see what happened today in the market. I work a little bit similar to you, where if it pops on my radar, like everyone's talking about it, then I go, okay, what's going on now? I sort
yeah.
of use this Warren Buffett framework a little bit, and I didn't steal it from him. I just think we all sort of do this when you're investors. It's like, when everyone's like, oh my God, the market's great, everything's fantastic, I sort of stop paying attention. I go, well, probably there's nothing really to buy unless there's something on my list. I go, okay, whatever. I'm not paying attention. I'm not buying anything, because everyone's in euphoria. But then everyone's like, oh my God, the markets are going bad. I'm like, okay, well, that's typical. Markets are always going bad. But when I start hearing the market's collapsing, it's going horrible, I go, oh, okay, I'll start paying attention now. What's going on here, right? I'm not looking at a selling opportunity. I'm going, oh, there's probably some stuff that I already hold that might be on sale, or there's
Yeah.
my watch list is on, like, okay, now let's go look back at my watch list. Are they now hitting the prices I need them at? Because, and then it's like, oh my God, the world is ending. The economy is going to break up. And I go, okay, great. Now let's start buying. I might dollar cost average slowly when everyone's in panic, like freaking out completely. I go like, great. But when everyone's like, the economy is going to collapse, that's when I started dumping in money on a select portion of companies that I've already vetted for like that's just been sitting there for years. And I go, great.
Yeah, so it's a no-brainer. You're just like, okay, I can just buy.
It moves so fast. I can capture it immediately, and then I always have available cash sitting there. So I did that in April. So when April, I was like, oh my God, this was such a great opportunity for me. Let me frame this properly. If you're retiring, you need to cash out in that period. That sucks. But you saw how it was like a V bounce back. It bounced back so hard
Yeah.
because it wasn't real, right? And I knew it was going to bounce back hard. And I have proof. I don't know if I think I made a video saying I'm buying this in April. I made a video being like, here are the stocks I'm buying. And I did it really willy-nilly, really fast. And I showed it was that Thursday, Friday, and that Monday that was horrible.
Yeah.
So I made a video in there being like, I bought this, and I showed not everything I bought, but at least like a good $50,000 to $60,000 worth of things I just bought quickly, because I'd already vetted all of them, and they all bounced back. And I said, oh yeah, they'll bounce back within a year. They bounced back in like 6 weeks. And then, but like, that's how you capture it. So but I use news as like tariffs. The world is happening. The world's ending. I'm like, oh, okay, great. Sounds like real panic setting in. That's when I last really paid attention to the news. And then I was actually listening to the news every single day and going, okay, when does shit hit the fan? Shit just hit the fan. Great, buying opportunity. And I just kept buying. I went buying Thursday, bought Friday. I held back cash because I'm like, it might keep dropping. Boom, kept dropping on that Monday, and then it started slowly going back up with maybe like a small dip. But that is the strategy. That's how I use the news. That is the only way I use the news. If it's stocks you hold, let's say you hold Apple, National Bank, What reason is there to listen to the news? Like, there's nothing. You don't need
Yeah.
to hear about them. Do you put a lot of time into reading financial statements of National Bank, other than like you enjoy doing it, it's what you do for a living? But if it wasn't your job, and these just core holdings you had forever, would you? Does it matter? Does it affect you in any way to even look at financial statements, or you're just like, I know this will be here in like 10 years? It doesn't make it.
What I do, I believe it's really important to review my portfolio every quarter. So it's
Mhm,
more like a monitoring, and
mhm.
it only takes a couple of hours because, as you mentioned, if I pull out the press release for National Bank and I see that they still have four segments, business segments, everything looks good. There's nothing to worry about. The numbers are great. I mean, that took me probably 2-3 minutes to figure out, and then I move on
Yeah.
to the next one. But sometimes you're just like, hey, it's not going as it's supposed to be. And I'm not talking about the stock price here. I never look at the stock price. It's kind of funny. I even realized that I don't spend any time looking at stock price. I look at facts. Because
Uh,
and it here's kind of funny. In 2020, when COVID hit, if Dividend Stocks Rock would have been a public company, it would have lost like 30%, 40%, 50% of its value. But really, it opened like it was one of my best year ever. So in terms of growth. So that was like a lot more interesting just because the stock price would have dropped. But on the other side, I would have made so much money because the business was doing
oh,
very
if you
well.
wanna just 1 second here, in 2020, if you were to you started going into,
Yeah.
if you were to assess your company in 2020.
So if we go back in 2020 when the market crashed, if my company Dividend Stocks Rock would have been public, I would have probably lost like 40-50% of value at that time. The irony was my revenue was growing, my profit was growing, and it was one of my best growth ever year ever. But the market would have not seen this. They would have just panicked and sell the stock. So while the value of the company was down, I was actually making more money, and it's actually happened to a lot of other companies. So that's why I don't look at the stock price. I look at the metrics because the metrics speaks a lot louder for the long term. And then sometimes people are just like, "Yeah, why the stock is down or why the stock is up?" I'm like, I don't know. Like, I don't really care to be honest, because
Yeah.
the point is, yeah, it's up for this week. What's going to happen in 3 months? I don't know. So you might as well make sure that you, as you said, you have a high level of confidence, you're comfortable with the company that you have, just monitor to make sure that it's still business as usual. From time to time, it's not. And this is where I will put a little bit more work into it, monitor for a few more quarters. Like a good example would be I have Starbucks in my portfolio. So Starbucks is in the middle of a transition. They're under pressure in China. They're struggling in the US. They need to come up with a new plan. So of course they get a little bit more of my attention in terms of metrics right now than they were like 5 years ago. So it's just a matter of, can they turn that thing around, or they're just going to go deeper and deeper and deeper, and then I'll see, well, my investment thesis was good for a while, now it's not good anymore. The metrics are telling me the company has hit a plateau and there's no way back, so then I'm going to sell. But this is how I use it. So I rarely trade on the quarterly review. I usually wait at the end of the year. And typically, I don't do more than 3 trades a year. And then sometimes less than that, hopefully less than that. My goal is really not to shuffle my portfolio around. I mean, you need to be patient if you're an investor. You need to think about the long game. And I mean, as it is the case with anything, I mean, you're never on your best day, right? Some days you're not going to be good. Some days going to be your partner that's not going to be good. It's just normal. So the business is the same thing. I mean, sometimes they will hit a wall. They need sometimes to turn around. So you have to be patient, but you cannot just say that business has been there forever, so it's all good. You still need to be rational about it. So monitoring the quarterly earnings is my way to do that.
You kind of answered one of my questions there. You said when the business looks like it's stagnant, that's when you start looking at like, okay, I should start selling my position in this. Um, is it stagnant as in you go, okay, the year to year return now is going to be so low that it won't be worth holding anymore? Because you got to look at that, right? If you have something that was giving you 10% return, 20% year over year, all of a sudden for the last couple of years, it's got 3% or something, 4%, the rest of your portfolio, and then you could be allocating that money to something else that's going to give you 10, 12%. Is that sort of what you mean by that? Or Sort of like, is that what
No,
you're
it's
looking?
really about the financial metrics because the thing is, from time to time, and right now is a good example for Couchetard and Apple, which are not positive this year. And even that was the same thing for Couchetard last year. So rather, when I talk
Oh,
about
yeah,
stagnating is like the revenue
yeah,
and the earnings and the
yeah,
dividend.
yeah,
It's
yeah.
really this because the performance, yeah, and it's going to
Yeah,
happen. But here's
you
the thing.
really don't look at stock price is what I'm saying. Yeah, you
No,
really don't. Yeah,
yeah,
it's 100%. That's interesting.
because I see my portfolio kind of like a sports team, right? So if your star player is not scoring today, that sucks. But you should have other players that are able to score as well. You cannot just rely on McDavid to win the Stanley Cup, obviously. So
Yeah,
here's the thing. I'm expecting that my second line and my third line is going to compensate for the time being, as
yeah.
long as I still have good value. So I would not trade McDavid after 5 games that he doesn't score any goals and has no points. I would be like, yeah, that's a big slump for my star player. It's not usual, but I'm still going to monitor what's going on with it and be patient with him. I'm just not going to trade it for like a second round draft pick, right?
Yeah, that's interesting. So I would say 75% of my portfolio is using your thesis, where I'm looking at, is revenue still going up? Is this company still, and I actually don't worry about stock price too much. And that's why I don't really trade them ever. I just have these positions where I have the Googles, I have the Meta, I have the things that I understand really in and out. I go, okay, everything's good there. But I do have, this is an arbitrary number, let's say 25% of my portfolio where I am chasing year over year growth percentage stock price, and that's sort of how I'm getting sort of overall portfolio yields of 36% over. Like I'm like supercharging it, and that's how I work. So I am trading a lot more often than you are, and I have a lot more things on my watch list. Like I bought it a little overpriced, but not really. UNH, United Health,
Mm-hmm.
because they went from 600 something and they crashed because of all their legal
Yeah.
problems and blah blah blah. But I was like, and I didn't have research, and I didn't put a big position into this. I now I've gone more conservative. And I just want to hear your thoughts on what I do. But this is part of my 25% bucket of, I don't go over a $10,000 initial investment into the one I do. I used to go really crazy and just like dump money, but I still do if it's a unicorn, a situation
Yeah.
like Meta was when it tanked, right? And I just knew it inside out. But for normal things, I do like a $10,000 allocation, and then I'll buy in. I bought a little overpriced that I wanted to. I bought just after Warren Buffett vetted it and put his money into it, and I bought like kind of around that time, so it did bump up a bit. But I just wasn't good enough in it until I was like, all right, if you did, but I've been watching it for so long, and I was like, this is the one I want to buy. I didn't buy it all time low, so that was the only mistake I felt like I made. I should have trusted my instinct and bought it before he said the announcement, and just followed my instincts. But anyways, I bought that $10,000. And this strategy, and I have if you go to the Gary Gill Wealth Academy thing, you can just go there and download a PDF I put together of just like why I bought it. But more or less, I bought it for the reason why the risk and reward looked okay. I knew they had legal problems. I think they're too big to fail and a bunch of other stuff. And I know that it's going to return in the end higher than the 10%. It's going to outperform the S&P 500 this year. It's essentially all I come down to. I'm already up 10.1% on it. Right? I bought it like 2 weeks ago. So it's like, I already know it's going to, so with that $10,000 in my brain was better allocated towards this than it was putting
Mm-hmm.
in VFV. If I were to buy VFV right now at $160, right, it's going to go up 2% by the end of the year,
Yeah.
right? For me, I take that $10,000, put it into UNH, and then essentially it'll turn into whatever I have a sell price. I'm just gonna wait till it hits another all-time high. It will eventually, whenever it gets there, as long as they don't go completely under. But I put $10,000, and if it goes under, it goes under. I'm okay. I can live with it. And then
Yeah.
I essentially, what I do is I once I do the sell, I actually do eventually sell it at my actual sell price. I take that $10,000 initial investment, put it back into my cash deposit, find another investment with it. I take those profits and I put those profits back into a core holding.
That's
And
interesting.
I'm just cycling it back in, back and back and
Well,
back, and I kind of go like that.
I do something similar, but with a smaller portion of my portfolio. Because the background I come from is I used to spend 3 4 hours on the stock market, during my daytime job and just buying and selling all the time, right? So I find it very exciting. But then over time, I'm like, yeah, I need a real strategy with real investment rules. And that there come the dividend triangle and the focus on dividend growth. But I allow myself to have 10%, up to 10% of my portfolio into what I would call speculative plays. So similar to you, opportunities, but the goal is really short-term gains, like maybe a year to a 2 years maximum, and a little bit more risky, never more than 10% total, never more than 4 or 5 ideas. So maximum 2% of my portfolio into one single idea. And by using this, for example, in 2020, I used the full 10%. I was just buying and selling, having a lot of fun, create a lot of profit. And that's outside of my portfolio strategy. And then from time to time, right now, I don't see many interesting plays. So most of my portfolio is just fully invested in dividend growth stocks. But then if I see something, I may trim some of my Apple, of my Couchetard, for example, to get back on track and say, hey, I have like a 1 or 2% left, and then I can invest it into a great opportunity. And actually, UNH has been highlighted at the DSR as a great buying opportunity, but I was a
Really?
bit fast on this one. Yeah, I was.
Mm.
It was in the middle of like the first problems, not like after the catastrophe quarter when the CEO resigned, and so then
Yeah.
we highlighted it too fast. See, you got it too late. I got it too fast. So sometimes
Yeah.
not easy to get the right timing on those
I
things.
got I got it good enough where I'm still up 10%. I think I just a little bit upset that I should have listened because I had my rule set and it met all my criteria and I was just being a weenie. And I was just kind of like, and I think the legal stuff and too much it just got to me a little bit. And healthcare isn't tech is my sort of forte.
Yeah.
And I think there was this, and I shouldn't have doubted it. I should have stuck to my rules and just got the goddamn thing. And it wasn't until like I was like, oh, okay, Buffett got into it. Like, I knew I was right, and then I got in. But I've earmarked that for I don't. So like now, here's how I'm going to treat it, and I guess you can just comment on this: is 3 to 4 year is when I was thinking about selling. I figured it'll probably get to an all-time high at least in the next 4 years. I think if they figure out their shit, like if they get all that
Yeah.
sorted out, if they don't, if I feel like it's nothing crazy happens and it's just more and more like sentiment and stuff, or nothing that looks like it's going to default, and the price goes down more, I then buy up in $5,000 increments. If it starts going lower than the price I initially bought in, and I actually start buying up more as long as it's still have high conviction. But I wouldn't have bought it if I didn't. So I would probably still because I'm prepared now for it to keep possibly dropping for another 12 months while all this is still happening. So I'm like, okay, well, it could actually, like, it's up 10%, but it could go drop by like 20%. Something crazy happened. I'm like, okay, well, I'm going to keep buying in because now I'm in with this one. So that's kind of where I'm at with it. But I keep an eye on it now to be like, is there something here that happens where it's like they get like really screwed over? All the DOJ stuff that's happening with Department of
Yeah.
Justice, if it actually starts crumbling down, I'll try to get out as fast as possible. But for the most part, if it doesn't look like that's going to happen, they are too big to fail. They can buy off enough politicians and do whatever they do all that corrupt. I'm really hoping with this one, corruption works, and whatever they're doing, they get away with.
Well,
I don't know what.
I mean, on the other side, they're so big
That's what it
providing
was.
those services in the US. It's like any of the big 5 banks in Canada, they cannot really go under in a sense where the government cannot let that happen, because if it happens, the entire economy is going to die. So that's going to be like a major blow. And for that, they have to ponder like, okay, so maybe we should help them getting back on track instead of destroying the company and then destroying half of our healthcare system at the same time. And it's already broken anyway, so you don't want to like add another layer of troubles over there too.
I think that's the main reason why most people are buying in. That was a main part of why I was looking at it. I'm like, they're just too big to fail at this point. You actually can't have a company like that off the board. It would just mess. Their contracts are too large. They're just providing too much of a service. You can't just have them go under. And I was just thinking, if I'm buying at the right price, remember, like the buying price is my highest margin of safety. If I can get it low enough, that's where it was. I was just upset that I didn't follow my rules exactly, and I kind of let emotion. But in most cases for people, emotions get into play of emotional selling, right? It's, oh, I got emotional and I sold because I heard that sentiment. Like they probably would have
Hmm.
sold that stock when it crashed, and you probably should have. But when it crashed, but for me, it's emotion of not buying on time. It was like, God damn it, I should have bought it. That's typically I never emotional sell. Um, Talk a little bit about that though. Have you been in scenarios where you're like, oh my God, I should sell this stock? Have you ever done emotional selling? Are you pretty good when it comes to that, where you looked at the fundamentals, you know it, you don't pay attention to stock price, but has there been ever a scenario in your life where it's just something so chaotic where you can't but pay attention to stock price?
I have a unrealistic risk tolerance, I would say. So I cannot have that emotion of panic selling, but
Yeah.
that comes from, when we drove all the way down to Costa Rica, it was all fun. And I mean, you just can picture yourself playing with your kids by the beach and having a fun time. But we probably nearly died like a couple of times during that trip too. There was like stuff that was scary as like, yeah, very, very scary. And when we came back in North America, I just said, well, my perception of fear has completely changed. So losing half of my portfolio overnight, I really don't care because I
Yeah.
know how to make money. I'm just going to
Yeah.
work harder. It's going to suck. You're going to
Yeah.
hear me screaming and swearing for a long time, but I'm
Yeah.
just going to double down and work harder to get my business back there, to get my portfolio there. So I don't care. Like when COVID hit, I saw my portfolio losing like more than $100,000 back then, and I was like, "All right, that sucks." But I mean, that's what it is, you know. Like it's time to pump out more content to double down the business, and the market is gonna do the market. So never happened to me. I made mistakes selling, or I sold too late, but not because of emotion. Just for sometimes not necessarily having clear rules over time. I refined those rules. Like for example, one of my selling rules is when the dividend triangle, like the trend for the revenue, the earnings, and the dividend is slowing down, then I can going to pay more attention. But before, I used to give more weight in my decision to my investment thesis. Like the reasons why I like that company so much. So the story I tell myself, but the story can be pretty convincing. But if the numbers are not there, at one point you have to sell. Instead of trying to convince you that, yeah, this is a good company because they're doing this, they're doing that. Well, I can tell you, hey, Gary, I train like 7 times a week. I run, I do weightlifting, and then I do jujitsu and so on. And then you watch me just like, Mike, you're overweight by like 100 pounds. Like, you can tell me whatever you want. You're not.
Yeah.
The facts are you're overweight, and I don't believe you. And
Yeah.
that's pretty much the same thing when I look at some stocks where I made mistakes, was just being too much convinced about the narrative and just telling myself the numbers are bad, but it's only temporary. I mean, you need to be more realistic and
Yeah.
stick to the reality here. So that's actually where I made the most of my mistakes, not by panic selling, but by keeping stocks that I see it coming and still holding on to that investment thesis. So now I gave myself, I'm like, you know what? If the dividend triangle is not right, I sell. Like
Yeah.
I give myself like a 2 years period where I can monitor the stock, 2 to 3 years if it's a really good company. But if everything starts to go down all the time, it's just going to be okay. There's no, I don't care if they make a turnaround in 5 years from now. I'm selling, I'm moving on. And that has saved me a few times since then.
You don't use the exact investment strategy. Like I told you, I use 25% where I'm kind of flipping them between 1 to 4 years. Like they're not long-term holds. I think 1 to 4 years is probably the ratio. But you said you sold too late. I sold too late early on in investing where I sort of similar as you, like, hey, maybe they'll turn things around and, I'll do it. I learned that lesson. I just lose, I only lost a little bit of money with that happening to me, but it did, I think I overcorrected where I have stringent, like I said, enter and exit numbers for me, like on those at 25%. I go like, hey, if it hits this number, I'm selling regardless. I'm just out. And then if it hits this number, I'm coming in regardless, right? Even if it keeps dropping, I'll just dollar cost average into the drop and then I'll sell it. But I think I'm trying to mentally maybe let the winners ride a bit more
Hmm.
if it's going up, and I don't, and it, because like I don't really get upset if I sell it. Let's say I sell a stock at $10 and it goes up to 15. It doesn't bother me. I don't think as much as it should, only because I set out 2 years ago when I bought it at 50 cents. Or I don't buy penny stocks, by the way. This is not a number. I never buy penny stocks. I'm just doing it just so the math is easy, so I can do the math a little bit
Yeah.
easier. So it's just for me, so I don't have to crunch big numbers. But it's because I bought it and I go, hey, when I bought it at $1, I told myself if it got to $10, I am selling. I'm out. Because that is where I think it should be at. I'm out. But then it gets to $15. I'm sort of trying to tell myself now, I haven't started this yet. Let the winners ride. If it's at 10, maybe don't sell. Maybe just if everything looks normal, it's like you said, so profitable, the company's doing great, sit on it a little bit longer and just let it. And I think that is a new thing I'm starting now with all this is like, let's say if UNH, we bought this, it goes to 600 or whatever. If it like, I'll probably sell at like 500. I got to check what my actual price is, but I'll be out of it real fast.
Mm-hmm.
But if everything looks good, and I put a little note in this document that I put together, it's like a 2-pager, I said, if the fundamentals look good, they've cleared everything up. The company itself, all the legal problems are gone. They're
Yeah.
great. They're just a good. Why would I? A good
That's a
company.
long-term holding at that point. If
Yeah,
if
it
they
switches up.
solve everything, it becomes a long-term holding.
Yeah, that I'm like, why? And I did that with Meta, like, but I understood it so well where it was like, I'm gonna buy it so cheap, and I thought maybe I'll sell it, but I just kept holding it because I'm going like, this company's great, and it just keeps going up, so I never ended up selling it, right? So, and same with Google and stuff like that. I'm like, I need to start, I think, letting those winners ride. If they, once they hit my benchmark, take another review, go, should I sell, or wait a
Mm-hmm.
second, is this actually now? Am I going to take it out of the 25% bucket, add it to the 75% bucket of long-term hold? I think that's something I'm gonna, I don't know, add to my strategy.
I've been holding my winners and letting them run like forever. The only thing that I've decided though is my exposure to risk, because with Apple, I had to set a limit because at one point it went up to 17% of my portfolio. And I
Yeah,
was like, am I comfortable? Like, and here's the trick. I imagine the worst. Imagine I'm wrong holding Apple today. So my exposure to risk is roughly losing 50% of it before I say, okay, that's too much. I just sell. So what's my level of comfort at this point right now? It's 9%. So am I willing to lose roughly $25,000, like 4.5% of my portfolio on a single mistake, like being wrong on that stock? So
yeah,
if the answer is yes, well, there you go. I'm good. So I can continue. But at one point, you're going to hit the limit. Of course, if I say, okay, Gary, you have like $500,000 invested, that's all you have. Like, are you willing to bet $500,000 in one stock? You're going to say, no, that's too
no,
much. Okay, so what about 100? Oh, but that's too much. Maybe 25 is like, oh yeah, 25, I'm good. I can lose 25. So then your maximum is like 50. And every year, like once a year, I look at it, and my personal one is 10%. So Apple, if it bounced back this year, I will have to sell 1 or 2% of it. I just trim just a little bit, just to bring
yeah.
it back to 8. And I did that a few times. And it's to keep my winners winning, but at the same time, protect my portfolio from myself. Again, same thing, circling back to that investment thesis and everything's go back. When you make money out of stock, you're just, you fall in love with a business. You're just like, hey, it's working. I want to keep working more. But then one day you have to draw the line. So I drew mine at 10%. Someone else could be 6. It doesn't matter. Like the point is to have something clear, so I don't have to think about it. I don't have to reflect on Apple and do a whole analysis. If it's at 10% at the end of the year, I'm going to sell 2 and then I'm going to move on. It's going to take me like 2 minutes to do the trade and I can go on with my life. And if it's at 8%, well, I don't have to think about it at all, and I just move on still.
As we're talking, I'm realizing, like, me and you have very clearly defined strategies,
Mhm.
rules. Like in my brain, it's just like I'm on autopilot, just happening. Like I'm learning to write it out now for other people to understand what I do and talk about it. But it's just like I know how I invest. You do too. You have a whole company where you like help people with it. Um, how important is it for then investors to understand that? Because I feel like a lot of people are now just a lot of investors who think they're investors are just buying, selling stuff, seeing stuff online, and there's no like. My brain just feels like, oh my god, I would feel like chaotic and crazy, like no strat, like you can't, like we run businesses, you can't extrapolate income, you can't extrapolate how much you're gonna have in 5, 10 years, you can't. It's just you're floating and you're wishing for the best. And I feel like whenever you're wishing for the best, that's when the worst happens. Right? If without a game plan, without a roadmap, without a strategy, you can't get to where you're going. You can't be that guy who's like, I'm gonna start investing, become a millionaire. Well, how are you gonna get there? Exactly.
Yeah.
It's not like I'm going to buy GameStop and become rich. That's not a strategy. It's like, what is my, how do I tackle this behemoth called the financial capital, the capital markets, and come in and not come out a loser? Because, rule one, don't lose money. Rule two, remember rule one. What structure do I have in place to keep me in line? And obviously, working with guys like you give people a framework and all that stuff. But do you think that before people invest, they should have some semblance of that before they even spend a dollar of like, how am I going to approach this thing, rather than just buying a
It's
stock and seeing?
yeah, I think it's super important. And the problem right now with the current market is you buy anything and you make money out of it.
Yeah.
When I started investing, it was in 2003, and it was like that. And it's kind of funny because I was just like buying and selling and making money, and I'm like, hey, I'm a genius. I figure it out. I'm like 24. I'm making like 70% return every year. I actually borrowed 20 grand, and then when I bought my house, I had like $75,000 as a cash down, like all
Oh,
borrowed
wow.
money
Yeah.
that just blew out of the water. But then I was like, okay, so I'm about to buy my second house, and then I'm going to play. And I played with penny stock at that time because I thought I was just a genius, right? Because it was just a good years. And long story short, I lost a lot of money on the bad trade. And then I realized, oh my God, I don't have a strategy. I'm going to lose a ton of money. And then I woke up and I'm like, I need to have rules. I need to have like a framework that I can work with. But it only happened to me once I lost money, which it's not happening right now. So people are just like, yeah, it's all good. And then they see a stock that goes down 10, 15%. And it's kind of funny because I started to be a little bit more active on Blossom, where there are like a lot of new investors. It's an amazing community. It's a great place to learn. But I see a lot of panic because of stocks or products that are going down. And as of late, we saw MSTE, which is a really, really popular
Oh, I got a
covered
bunch of
call
that.
ETF on MicroStrategy. I mean,
Yeah.
hugely popular. And I'm not here to destroy it or anything, but
Oh, go
just
ahead.
yeah, this like it started to go down and down and down. At the time of recording, I think it's like maybe down 20% from its peak value or something like that. But anyways, the point being, people are panicking. You're just like, do you think it's going to go up? And then the comments are just like, oh yeah, I'm holding. It's going to go up. I mean, if you cannot bring a rationale, and then I'm trying to educate people, is like, okay, so MSTE is writing covered calls on MicroStrategy. Do you know what MicroStrategy is? Because if you have no clue, you're literally throwing money up in the air, hoping it's going to go and come back, and hoping is not an investing strategy. So then you need to understand the business model there. And if you do, then you understand that they're using leverage to build a Bitcoin reserve. So they borrow money, they issue preferred shares where they pay a juicy dividend to buy Bitcoins. So long story short, if Bitcoins doesn't go up, MicroStrategy doesn't generate any cash flow. So they have a problem paying down that debt. So that's their
Hmm.
business model, for the better or for the worse. And then you're writing covered calls on that. Do you know what that means? That means that if the Bitcoin remains stagnant,
Yeah.
MSTR is going to remain stagnant, and therefore, and it's probably going to go down a little bit, and therefore, no one wants to buy a covered call on a stock that is not going up. Why would you pay $2 per contract for a stock that is trading at $100 when it stays around there? You're not going to like, oh, I can buy it at a 110. That's amazing. But the stock went from $100 to 95 to 80. There's no interest there. So you're going to make less money writing that covered call. And on top of that, you're using leverage. Do you know what leverage does? When it's good, it's amazing. It amplifies. When it's bad, what's even worse because it destroys the thing. But if you don't know those three things, what the business does, what writing covered calls mean, and what leverage means, well, then you're in for a party because
Yeah.
you're just going to hope. And I'm not saying it's a good thing or a bad thing to invest in MSTE, but I'm just saying if you don't understand what I just explained in like 2 minutes
Yeah.
in like very simple terms, if you're not able to do that, you're missing something out of that investment you're making. And that is super dangerous.
I
And that's up to you.
I did a 15-minute video on my YouTube channel breaking down everything you said. I basically just get into, by the way, I own so much MSTE and because I make videos, that's why I'm laughing. I'm laughing. It was like, is that $12 today? So I'm down like $3,000 on or something. I don't really give a shit. Because I made a video just breaking down. It was a video that's 90% being like, dude, like you're talking about covered call strategy plus tied to crypto plus leverage. It's like you got to understand, like this thing is gonna start, like it's gonna crash no matter, like whatever it was at $18. Like there's no way around it. And when guys
Highly
don't
speculative.
huge so much. I'm like, so just don't buy it if you aren't okay with this. Like,
Yeah.
do not go near this thing. And then I went ahead and I have like $40,000 worth or something crazy. So there you go. But I mean,
if you're aware of it, that's not a problem. The problem I see is most people bought MST for two reasons. Oh, the yield is crazy, and a lot of people are talking about it, which are two very, very bad reasons to buy anything.
Yeah,
like the yield
coming
is
from?
nothing. I mean, it's if you don't even understand where it's coming from. And by the way, they reduced their distribution twice already, so
Yeah,
it's not something that is 100% guaranteed. It's very far from being like money market funds. And then a lot of people are talking about it, as you mentioned earlier, when everyone says like, "Hey, it's time to buy, it's time to buy." It's the time to like sit down and don't do anything. So you might as well just do extra research when everyone is jumping into a boat.
Yeah, like like mentally for me is because I have a covered call portfolio, even though I'm not a covered call investor technically. I'm actually I've been public, like 95% of my portfolio is VFV plus single stocks that are value buys that are all, that's when I say I'm performing at over 30% portfolio wise, I actually don't add in my covered call part of my portfolio into that equation. They're two separate entities.
Okay.
But for my covered call portfolio, I have things like I actually just trimmed it all this morning before we got on the call together. I just like sold a bunch of shit. Just because like I was just tired of looking. I had a bunch of like a couple of shares here, a couple of shares here. I was making content on a lot of this stuff, so I just owned a lot of stuff. I was like, all right, let's just trim it all back and just like I'm just gonna focus on a couple of companies to talk about. But I have HHIS, which for me has been pretty good, I guess. MSTE, and then I have USCL. Okay, and I'll talk to you like psychology wise. MSTE, I wanted something highly volatile, highly speculative. Like I'm looking every downside you mentioned, right?
You find your match made in heaven.
Yes, because I'm like, okay, great. And I was like, all right, I'm cool. I have 40,000 in here. I'll probably trim it back eventually. It just doesn't bother me right now. I'm like, it just doesn't bother me, and I want to make more content about it. I really, because there's a lot to talk about with it. Because there's so many things happening that I need people to understand. And I have a lot of people online talking about like the downsides and the positives and stuff, but like a lot of people talking about downsides typically don't own it. People who talk about the positives own it and have to justify owning it. I own it. So let me just tell you both, like hammer it. And then you can know like, okay. And I have a sizable position. I have $40,000 in it, $40,283 in it, which is, I think is like, all right, great. So his skin's in the game here.
Yeah, definitely.
But for me, I guess in my brain, it's almost purely negative. I don't see a whole lot of upside as far as I would never buy it if I were just using my other strategy. But for a covered call portfolio, I'm willing to tolerate super speculative, super high risk, see what happens, because I have a whole other portfolio. Like I have 95% that is what I actually rely on. And I have 5%, which is like, oh, this is fun for me, kind of interesting. I can make some fun content. And it's in a space, because covered call isn't my strategy, where I'm actively learning about. So you're kind of seeing me like learning in real time. But I just couldn't justify buying it if I was just using my actual strategy. Like I don't have a clearly defined rule set other than MSTE is volatile. I don't see what happens. I own high shares with it. How am I going to manage all this? I'm interested to see how I navigate the volatility. What am I going to do there? How do I come from that? How do I make sense? How do I make this into a good investment? If it's even possible. With USCL, I was like, okay, well, I need something that's kind of a core position in a covered call, right? And USCL is basically just writing covered calls on the S&P 500. It's this equivalent of holding a covered call VFV or something like that, right? So I'm like, okay, that'll be a core position. And HHIS is sort of like
all the concentrate.
Yeah. And it's like a concentrated NASDAQ. That's what HHIS, right? I'm like, all right, great. So I got NASDAQ, S&P 500, and I got crazy crypto
Bitcoin
exposure. But I got like hyper volatile. I have the worst case scenario Bitcoin, because I have leveraged covered call Bitcoin, which means I'm not capturing upside, getting all the downside, right? And like you said, nothing's happening. So you're like, you're in a weird place. So I'm like, okay, what do I do with like worst case scenario in this position? So just saying that's like, oh, I got a lot to talk about now. There's a lot, right? Right? So I got a lot to talk about. I can do one video a week just on just the position I got myself in is at least one video a week. So that's sort of why though. But then when you understand my framing of why I'm doing it, it's not any of the reasons why everyone else is doing covered call ETFs.
Yeah.
It's like I'm not doing it for income
You're not
generation. I'm
looking for
not
the income. You're looking to learn and for that speculation. And
figure out.
again, understanding why you have it is a big
Yeah,
part of like if it's a good fit for you. And as you said, you already have a portfolio around a well-defined strategy. So now this
yeah,
is like I'm having fun and I'm
yeah.
learning. So that's great.
It's all, and for me, it's like almost like a safe trial run of like I always thought like, hey, maybe I'd convert some of my portfolio into dividend heavy portfolio when I get into retirement. But I was always going to use like stable dividends, like an XEI or something. That's like a 4% that like so boring. Like if I have VFV,
Yeah.
I'll turn VFV. I'll turn 10% of my VFV into an XEI and capture some dividend off that and stuff like that was my initial thing. But I was like, this cover call thing. There's a new product every week at this point. How about I figure out covered calls right now while I'm far away from retirement? And is it worth actually doing when I get into retirement? By the time I get to retirement, I actually have that large portfolio. Should I even bother converting any of it over? And if I still have this
Yeah.
portion of my portfolio, if I got it to grow, fantastic. 'Cause I'm just reinvesting all the dividends back into those things. So, and at the moment, it seems like the only way covered call works is if you're constantly reinvesting your dividends back into to buy more shares,
Yeah. So you're not getting the income.
not getting the income. And it's
And
all
it's
about
it's like saying like the growth investors, and this is that's what I found funny
yeah,
about that debate on bond size. Like people are just like, oh, for growth investors, it's not like realized gain if you're just like capital gains that are on paper. And I'm like, fine, well, it's not income if you have not taken it from your portfolio into your pocket and spent something with it.
yeah,
And the math here, I mean, I was a financial planner for 10 years. No one will convince me that you can withdraw 25% of your portfolio. I don't care where you invested per year, and that's sustainable because you need 25% return. And if you match that, well, you become the next Warren Buffett and Peter Lynch. So good for you. But if you can go through that through your retirement for the next 30 years at 25% return, you're a genius.
yeah.
So, or you invest in a product that is made by a genius, which so far has not been created yet. So we'll have to see. But I'm definitely on the skeptical side.
I want to hear more of your thoughts on this cover call because there's a lot here, and it's you're the dividend guy online, and technically this is kind of like dividends, those covered calls. So
It's
like
not dividend. We have to put it straight. It's distribution. Big difference.
there is a solid 0.01% of these that is dividends somewhere in there, right?
Fair enough.
There is.
Fair
So
enough.
technically, yes. Okay. It would be horrible if this was dividends. I have this in my non-registered account. So if these paid out dividends, it wouldn't be as good
Yeah.
because this is all American stuff. Like it's actually better that it's like return of capital and stuff for me technically. So let's say HHIS, MST, USCL. Okay, now there's a couple of things here. Let's say I get this, it's at $100,000. I'm just pouring back, reinvesting my dividends. So technically, let's say I get it, I never sell. Let's just keep it going till 55. I get it up to like $250,000 or 300,000 or something, right? Just all reinvesting. But now I want to live off of it. My thing is there a magic number of how much of the monthly payment I should keep? And that's what I'm trying to figure out, I guess. I'm just talking out loud to you, is how much of the monthly payment do I keep? How much do I reinvest to keep the stock value, keep the value the same, and equate for inflation? But then also how much is left? Oh, and then also equate for taxes. Remember taxes?
Yeah.
I'm going to taxes on all this. What is left over and what is my spendable income? And that's what I would be able to live off technically. And now, is that even worthwhile doing compared to then just holding a VFV in my non-reg, selling off a portion whenever I need it, and just doing it that way? That's sort of the test. Is like if I use that strategy, but I have to do a couple things there. Like it's not as easy as like people go, well, if you buy covered call ETFs, you never have to sell and convert it over to a dividend paying portfolio, because that's a lot of people in retirement, that's what they talk.
Mm-hmm.
Go growth, dividend. In your TFSA, I feel like that argument is nil a little bit because you only worry about converting over your portfolio when there's tax implications. If I convert my portfolio TFSA over dividend, I don't give a shit. I just converted the whole thing over and I'm fine. Now I'm getting the dividends. It really only applies in non-registered accounts, tax sheltered accounts, that strategy, or the reasoning. And that's why I'm like, okay, cool. That's why I'll never have it in my tax sheltered. Cause I'm like, if I'm going to build this thing up, I got to make it work in non-registered, because that's where it makes the most sense. I want to capture growth in those other ones. So for me, it's all right, great. So there's one value is I'll never have to convert. I will buy these 4 positions, even though I'm sure HHIS probably won't exist in 10. Who knows if it'll be like whatever. MSTE will probably have imploded, but I'm hoping there's a couple.
Well, on both sides, MSTE is either going to make you really rich or really poor. It's
yes,
one
yes.
or the other, actually.
Yeah. But then I'm hoping there's core positions like, let's say, an HYLD from Hamilton, which is like VSP, USCL, which is like VFV, and then QQCL, that's the other one, which is like whatever, like it's just NASDAQ, right? Those are core ones that give a decent yield. And maybe Bank, BANK by Global X, UTES, which is Canadian Utilities. I'm like, those ones, you build those up. There's not a whole lot of NAV erosion, but there is still NAV erosion. So the amount that when in 10 years that I have to pay back into the fund itself to keep it to okay for NAV erosion, inflation, and taxes is far lower, right? And then the payment for dividends is worth it. And I never have to deal with the fact of selling anything. And when you do the math, it's like, oh, I was actually net positive than actually selling shares like that. And then in the entire time in the 15 years, I always had access to capital whenever I needed it through these as well. So I guess technically peace of mind of like, I can always just use that. Hey, I want to go to Hawaii for a little bit. I'll use that money. I just won't reinvest 1 month and I'll go. And there's that sort of quality of life. So I'm trying to, what I just outlined, I don't have this, is can I build that? Can I build that picture I just outlined? Having a stable, somehow covered call portfolio that I'm constantly reinvesting, that I can use for income every once in a while when I want to just do something fun. Because I do have a hard time spending money on myself. Maybe I'll buy something that's for myself, but keep reinvesting. And then when I finally get to retirement with this, are they all fundamental covered calls? Maybe at that point that when the math checks out, it'll be a good stable source of income that I can sort of supplement what I'm already doing and go from there. After taxes, after I've reinvested to equate for inflation and reinvested back into the fund to equate for NAV erosion. That is is that a plausible dream to have? Is that a plausible goal to see if I can figure out? Because I am new. I didn't aggressively do this till New Year's.
All right. So here's how a covered call works. Okay. Just to go back there, and then we're gonna go to your question. So you have a stock that trades $100. Okay. You sell an option, $2, the option to buy that stock at 110. Okay. So you get the $2, you get the dividend in the meantime. So now 3 things could happen to that stock while this option is valid. The stock stays at $100. So you stay with $100, you get the $2 premium. You just made more money than if you would just have held the stock. The stock goes down. So if it goes down, you lose a little bit less, but you lose nonetheless, because the objective of investing is not to have like losers forever, right?
Yeah.
And the third option is the stock goes above 110, and then I exercise and I'm like super happy because I get to buy the stock at 110. You're forced to selling me at 110, but the stock now is at 125. Yeah. So every single time that happens, you cap your gain. So on a down market, yes, it is true that you're going to lose a little bit less. But over the next 20 years or whatever period, the goal is not to have losers in your portfolio, it's to have winners. And whenever you have winners, you cap those gains for the sake of like immediate gratification. It's actually the problem of the century, right? We always look for instant gratification. Same thing with investment. So because you get that $2, you're super excited, but then you left $15 of profit on the table. Actually 13 because you got the $2, but still, that's a lot of money that you're never going to have. So just for fun, if you go back to ZWB and ZEB, which is 2 covered call ETF, like BMO, one covered call ETF from BMO on the 6 banks, or using ZEB as just having the 6 banks all together. So I like this example because it cannot be more pure than this. You have 6 banks, or you write covered calls on 6 banks. Exactly the same thing. Well, they both exist since 2012. So we have 13 years of data. And out of 13 years, holding the big banks has always been better than writing covered calls on them. just because of the fact that your upper limit is capped. So whenever those banks are going up too fast, while you're on the losing side, yes, you made money, but you're on the losing side. So now, if you want to do this, it's not that it's not working. It's just that the cost of it is that you're leaving money on the table just to get a yield, just to give the financial firm the power to tell you, Gary, I'm going to give you 6% instead of 4. But if you decide to sell 2% of your banks and get that 4% dividend, so it's the same 6% that you withdraw, you're going to have more money down the road and you're going to be able to spend more money. The only difference is now you're in control and you're the one deciding how much your portfolio is paying you. So that's the two different mindsets.
The arguments I've heard against that, and remember, I haven't been doing this long enough to actually work off my historical own data to even see if this works. I'm just going off what other people tell me. Gosh, you guys can correct me in the comments, but I'll do my best to paraphrase what Adriano from Passive Income Investing?
Yep.
Okay, so his thing is, because he's growth investing with covered calls, he's reinvesting everything, so he's not living off of it, and that's technically what I'd be doing right now. It's you get paid out the monthly payment and you didn't capture the upside, but because you're reinvesting, you're getting more shares. So when he was tracking so your portfolio growth is at the same level as if you owned. So I'm going to use, if I own VSP, right? Versus if I own, if I own HYLD from Hamilton. Right? HLD is cover call with 25% leverage, I think. Right? And he says this only works when there's leverage involved. He said HYLD and VSP portfolio growth are the exact same since he's been holding it because he's reinvesting everything. Right? So for him, it's like, great, it's the same growth, except I never have to convert it over. Right? Only thing you have to equate for is you're paying taxes on the interim because you're getting paid outright on everything. So I wonder if that's been taken into it. But because he's in a different he's in like Panama or something. Yeah. He gets rebated on like ROC and all that kind of stuff. There's like a bunch of stuff where it's more tax efficient for him to use this strategy than it is for me in Canada. So there is something working to his advantage. I don't remember quite what it is. But for me as a Canadian, I have to consider, yeah, that makes sense, but I'd probably still be slightly lower because I'm still paying taxes on everything I'm receiving every month as well. So there's that. But that's sort of the argument. The argument is you're not losing anything because you're reinvesting all that money back into the actual stock, which means your portfolio growth is at the same rate, or maybe just below than what it would be if you had a growth investment. And they're willing to accept that for the immediate income as well on top of it for that quality of life shift. But it's not as disparity is not as large as if they never reinvested. Now, what I said, that's all fine and dandy when you're in that stage, if you're like a younger investor. But in retirement, once again, we get back to what is the magic number of what do you have to reinvest to make sure it doesn't depreciate to nothing. You equate for taxes, then what is your taxable income back at that? So,
and I actually ran the number with ZWB and ZEB, and I did it for GPI as well versus VFV of saying, like at retirement, saying, okay, every month I'm just going to either take the distribution on one side and reinvest whatever I don't need to withdraw, and the other side selling some units. And I did the calculation, so I'm not trying to time the market or anything. It was just like the first day that you can trade on every month. Actually, I did it for a quarter to make it easier. I'd either sell or whatever. And long story short, in both cases, the underlying asset always outperformed the covered call. Now, the other thing is it's super fun to do that comparison with HYLD, which has been around for an amazing long term of like what, 3 years?
Yeah, everything.
I mean, I don't mean to be mean here, but I mean, you like even when I did that video on GPI, I already highlighted I have like 5 years, which is nothing. It's not enough. Yes. Like it's nothing to do a comparison. That's why I prefer to get the other one, which I had like 12 or 13 years. Now you're talking about 3 years. I mean, 3 years, flip a coin. I mean, invest in Bitcoin all your money 3 years ago, and then you're richer than anything else that you have done. I mean, that's 3 years. It's nothing, you know, it's not enough to know if it's sustainable or not. So
I was talking to a covered call investor. Their podcast is coming out tomorrow as of filming this. So you guys will it'll by the time you guys see this, it'll have been online because I think you'll be coming out next week. So it'll be a week difference between your guys' two podcasts. But we are talking about it because I have 100,000, he has like 400 something thousand cover calls. I was like, by the way, I'm a research based investor. All of these, I'm always just going, I don't know because I have no historical data. No, like that's why when I talk to him, like, will HHIS exist? Will MSCE exist? Will US? I don't know, and it is the weirdest feeling where I'm like, and it's why when I mentioned before, I'm like, I don't equate it to my portfolio because I don't. I come from advertising. I'm in finance. Everything is data driven. Everything is historical performance. I know you can't use past historical performance, but it gives you something to work with, right? And it's just like you have absolutely nothing, and I don't think people understand that. I think they're thinking they're dealing with sure things where I'm thinking I'm dealing with stuff that could just disappear. And in the investment finance world, this can disappear technically overnight. In finance world, we're talking about, when you're talking about Microsoft, they've been around forever. The lifespan of an HHIS is a few months or so. Like it's this year. So on the grand scheme, overnight, if it's gone in 6 months, it's gone in 10 years. If it's gone in 5-10 years, that's overnight. Right? That's not a real thing. So, and I think if you don't know that going into covered calls, into buying these funds, you're going to be in for a rude awakening eventually. Something's going to happen. We're going to be like, what the hell? I thought I was going to live off these yields forever. Oh, the yields got slashed again. It's like, yeah, they had to because the price keeps dropping. The stocks, all these horrible things can happen and you don't know what's going to happen and you can't predict what's going to happen because everything is being invented and created monthly, and it's all being created because of retail investor demand though.
Of course. I mean, investment firms are going to sell whatever you're craving for, right? And it totally makes sense. And I'm not necessarily saying that it's going to be bad, but like you said, I want to highlight those kind of risks because we don't know. A few years ago, it was all about split corps. They were amazing until 2008 happened. And then some split corp just forgot to pay their distribution for 12, 14 months. So if you're living on that dividend, what's going to happen to you? Well, nothing, because you're running out of money, and then you're stuck selling a preferred shares that is down 50% on top of that. So you want to hold it until it recovers. So that's fine. In the meantime, zero distribution for several months. I mean, that's scary. So I don't know how leverage covered calls will work. Covered calls ETF, they work. I mean, they provide the yield. We have history for that. And it's not the end of the world. And if you prefer not to be your own boss and let the investment firm decide the yield that you're receiving, and because you feel good about that, I mean, when you get to retirement, you want to replicate that sentiment of receiving a paycheck, right? You want to receive a pension. You want to receive a paycheck. You want to have that habit of receiving money into your account. And the more often, the better. I totally get that. But you're ending over some control. There's a price to pay. It doesn't mean that it's bad. I mean, I go to the dealership for my car where I could probably do a lot of things by my own, but I don't want to learn mechanics and I have no interest on it. So I'm willing to pay the price for that. There's nothing wrong about it. Now you go with leverage. Well, we need to see how it's going to be handling the next crisis, because we didn't. And don't tell me that April was a crisis, please. That was just a blip in the history of market, and no one will ever remember that. So, that's not a crisis. A crisis is when you lose 30% or more of your portfolio. That's a crisis.
This portfolio I have here cannot handle a crisis. This is at the whim. This is horribly, horribly exposed. I'm aware of that. That's why I'm hoping I learn really, really fast and figure out what I'm going to do with this thing, right? But it's okay. And another thing is, I have a lot of people who do cover call investing on my channel a lot because they watch my Adriana interview, they watch me do it with him. They subscribe to me, but then I put out so much content that goes I talk about MSTE and all, but I give so many negative side effects of it that they unsubscribe to my channel, be like, F this guy. And then they leave, even though I'm I own it, but I'm I gotta tell you, all this is happening. And a good thing to consider is there's this ETF investor. He's a YouTube channel called Marco Mila. And I follow him on every social platform. I got him on Blossom. I got him on Insta. I got him on YouTube. And somewhere on these platforms, he made a post that hit the nail on the head. He's like, I only invest in things that institutions invest in, because when an institution invests, it's not, that product or that fund is not meant to fail, right? So he's like, institutions buy VOO, they have it, right? So it's
Yeah.
not meant to. That's why I buy that. He's like, no institutions own covered call ETFs. It is 100% a retail product, and they don't give a shit if it fails. Is that right? And I went, oh, and by the way, he interviews
Ouch.
he interviews all the
I
fund.
know. I saw him like I thought he was like because I saw that he interviewed a lot of covered call ETF
Yeah.
managers and stuff, right?
He's in it. He's in it more than I am. He knows everybody. He has the ETF Academy on YouTube. He brings on everybody, and his sentiment is this. And he's, by the way, he's been like this since I've known him for a couple of years now. And he's been steadfast about his Vivio, and he's right, 100%. He's right.
Yeah,
And I know
definitely.
that going in, where I feel like the more I get up to speed with everything, and I'm happy, I'm not like, I'll be at break even, but I don't think I'll have even $1 profit by the time I'm done everything. It'll be at break even. I'll be great. I learned a lot. I learned a
Awesome.
lot. I think what I might transition is, because you keep saying you're losing control because you're letting the fund dictate. What do you think of then people who write covered calls themselves? Bassam Zahili, he is a finance YouTuber here in Canada. Really smart guy, successful. He writes covered calls on stocks that he loves, he owns. He's got Tesla stuff, like holdings he just like to have, and then he just writes covered calls on them. And he's like, "Oh, I get like 20% back overall in the yield, like my overall in the year." But he's got full control. He dictates how fast and slow it goes. If he even wants to capture that, if he wants to do the game, and he's in and out, but he comes out to about 20% in the year. What do you think when it's used in that way? When you're fully in control, you dictate. You're not just automatically doing it like these. Yeah. Like I said, so like right now I'm doing the covered call ETFs. Just because I'm new in the space, I'm learning on the fly. I started with a sizable chunk because it's, for me, data is king. I'm learning exactly what's not working. I'm at break even at best if you include all the dividends. Maybe even for my taxes, I can do tax loss harvesting a little bit, right? And be like, hey, I lost the money on MSTE, right? There's a lot of things I can do here. For me, it's not a loss. It's fine, right? YouTube ad revenue paid for this. It's fine. It'll make it. It'll pay.
Yeah, it's a business expense.
I honestly, I made a video saying, I think in the video I said, this is a business expense. I'm using it to create content. So like, it's the ad revenue is going to fill in the gap for this. So it was because all my ad revenue goes back into investing into the YouTube channel anyways. So, everything else. So I'm thinking, I'm like, because you kept saying control. I'm obsessed with control. I like the control. Like even I own VFV. It does bother me a bit that I don't have full control. I'm not, like, I could just be buying individual, but I understand why it's there. So I'm okay with it. It's just there as a sure thing. So it's about reasoning. I don't like the fact that the funds are writing the covered calls. They're doing all this. They're the ones using the leverage, right? They're doing all that kind of stuff. I'm like, why don't I just, Bassam Zahili is the one. He does it. He gets about 20 something percent return. He uses margins. Eugen Vasquez, he's another guy who does it. He does weekly pays because he's American. He uses margins. He does all this stuff. I'm going, you know what's really interesting? I think the same way mutual funds, people go from mutual funds to ETFs, and then from ETFs to go into single stocks. I think this is what's happening with me with the covered call world. I'm going from covered call ETFs into now just doing it myself. How about I pick semi-volatile companies that I wouldn't mind owning anyways? And if I don't want to write covered calls on them, I don't care. It'll just keep going up. Or I'll capture that growth. But then just as I'm learning cover calls, I can write cover calls myself on these. And when I want to capture a bit of that, when I don't think I'll be called on it. Right? When I go like, hey,
I
I think I can capture a premium here, but I think I won't, and I will obviously get called eventually, and I will lose that upside or whatever. And I can just do it that way. I won't get the overall yield of a 35% or whatever my portfolio may yield something insane. Maybe I'll get like a 10% yield or whatever.
Mhm.
But it's now a better strategy for what I do as a growth investor to learn about covered calls, to understand it better, and maybe get a 10% lift on top of whatever they're getting on my portfolio just from these covered call yields. Or from over like, yeah, I need some money really quick. I'll just write a bunch of covered calls and some stuff, sell it, like, something like that. What do you think of moving into that position with me and my strategy? Because I'm on a learning journey here. Remember, I'm learning. This is all a
Then
learning.
you're going to learn a lot. But I've discussed with a few of members at Dividend Stocks Rock that are actually doing that, like writing covered calls on their portfolio, and they're quite successful with it. I think that with the right level of knowledge and time, because of course then you need to study the options and the
Yeah.
spread between like all the contracts. But there is a way, if you like that thing, to write calls not too high, so just you capture some premiums, but you don't get exercised too often, because
Yeah.
that's the name of the game here. If you're able to not get over exercised most of the time, you're just collecting the premiums, and this is where the money is.
Yeah.
So it's definitely feasible. My guess is it's just a little bit more time consuming though.
I
But some people just see it as a hobby and they love doing that. So that's, I mean, it's a good hobby because you're making money out of it. So
I think that's where I'm going with it. I think I would enjoy it. And there's a lot there, by the way, because I just started dipping my toe into it. And I'm dipping my toe by going to Bassam Zahili's channel. He's a Canadian finance pro. He's got so much content on it. I just like watch what he does. But I'm so amateur at it. And I'm still sort of figuring this out that I think that's where I'm going to go because a couple factors. Once again, I think control. I want to have control.
mhm.
I want to learn. I don't know enough about it, and that bothers me. So I think I need to learn and become an expert at how to do that, just to know how to be an expert at it, whether I do it long term or not. And then secondly, I like video games. I like doing stuff. I like looking at numbers. I like understanding things. I think I would actually enjoy doing it thoroughly. Like I'd love, because I do have the time. I run an advertising agency where I'm advertising for people, but I have enough people working for me at this moment where I'm okay. I have a finance YouTube channel and I need to do something else. I have enough time right now to learn another investment style and get better at something. And I think it would be fun for me. I think that's where I'm going to be transitioning with this. So it's essentially I'll be slowly moving over this 100K probably into more of a covered call strategy. And how often do I write covered calls? Probably not that often. And suddenly I'm going from making my my dividends for last month were 1,660. For September, this coming month, if I don't sell anything, it will come out to 2,691 on basically those positions. It doesn't mean anything, right? I'm down
But I mean, it's
$3,000.
growing.
No,
Yeah.
no, yeah. I'm down $3,000 on MSTE. I'm at break even. Right? So like that's how I see. Nothing's happened. Nothing's happened, right? So I'm like, so everything is like, oh, I've been learning on the fly. I've been supercharging my learning, and I'm at break even. And by the way, that 100K was just sitting there anyways. It wasn't doing anything for me anyway. So right for me, it's like, okay, great. I think I'm gonna pivot that into that strategy because I'm on a learning journey. I'm not chasing revenue. I'm chasing knowledge. And I want to learn this
Yeah.
other investment style. And if I love it, I'll keep doing it. If I'm like, oh, this isn't for me, I'll probably get out of it. Because the more I'm doing this, I'm going for the main factor you mentioned, lack of control. It might not be exactly for me, other than maybe holding those core positions like AHYLD, possibly that's 3 years, like you mentioned before, but as close as I can get to having a core position, I think that would be the
Yeah.
extent of it. Okay, so that's our covered call to a tangent here, but I'm happy you clarified a lot of stuff. I'm happy you described exactly the downside on a lot of this stuff because a lot of people watch it are so focused on that yield, are so focused on monthly income, and especially if you're holding a non-registered account, tons of tax implications, NAV erosion, there's inflation, there's a lot of stuff you have to equate for before you then look at what's your actual income. What are you
Yeah,
actually living off
definitely.
of? Okay, that was Brooksfield we were at. Okay,
Yeah.
okay, that's how it works. See how I do it? How I weave in a million different things? Okay,
Love it.
okay, so the next one was, the ticker is, I didn't write down a name, sorry, number 6, STN.
Yeah,
And
Stentec.
Stentec, yes, there you go. Stentec. You have $16,000, 2.7% of your portfolio. You bought it at $108.23. Can you just explain what Stentec is and why you bought it?
Yeah, I wanted to talk about this one because it's one of my most recent purchase about a year ago. Stentec is an engineering firm. So what is interesting about this one is they do everything from planning, creating like the design, everything, building, and also maintaining the infrastructure, decommissioning it, and then taking care of it all together. So they have several business segments, energy, environment, and infrastructure. So they can take their clients, offer them multiple services, and they can go from the project from A to Z throughout the next 25 years of that asset living as well. The firm is also growing by acquisition. Again, the dividend triangle on this one was nearly perfect. Actually, I kicked myself because it flew under my radar for a long time. And when I looked at it, I was like, I need to add this one to my portfolio. And that's also a good example of like the fact that I don't look at the price. One of my member asked me, okay, so Mike, you bought it in September of 24, which was near the perfect bottom at that time. How did you do that? Because now the stock price is almost $150. And I'm like, oh, I didn't realize it was 150. And I didn't realize
Yeah.
I was like buying on price weakness back then. I was just like, I finally have money around. So, and that was due to my rebalancement. Back then, I sold my shares of Texas Instrument mostly because revenue and earnings were declining, but the stock price kept on going up. And I'm like, that doesn't make any sense. We're
Oh,
creating a
yeah.
discrepancy where the metrics are telling me it's wrong, but I'm making a ton of money on it. So I sold it with more than 100% profit. But the point was not the profit. The point was why the stock keeps going up while the company is not doing that great in terms of revenue and earnings. And it's not a bad company at all. But again, to your point of like earlier in the discussion, where can I allocate that capital somewhere else and make even more money? So
Yeah.
I sold it. I was already tech heavy on top of that. So that was making more sense for me to say, hey, I'm just going to rebalance my portfolio, get better diversification. And here's 10 tech sitting on my buy list for a while. And I got the money. I bought it right away, was super happy, and then realized, oh, the stock is going up. But it's going up because it's driven by earnings growth, not because of a hype or anything. And I like, there's a larger thesis here. I believe in the coming years, both in the States and in Canada, we're up for massive investment in infrastructure. It's already happening. I don't think we're going to slow down anytime soon. So, this type of business is showing a very impressive backlog of orders. It keeps on increasing. So, every quarter they say, yeah, revenue was up, earnings was up. And by the way, orders coming for the next 12 months is also up. So everything tells me it's going to continue to thrive. And this is why I added to my portfolio. So it's not a huge position in my portfolio. It's actually close to what I call a full position. So the full position is roughly anything between 2.5 to 3.5% of my portfolio. In an ideal world, I would like to have all my portfolio equally weighted. But then you have winners, you have losers that change a little bit. So of course, but when I enter into a position, anything between 2.5 to 3.5 is a full position. So I'm super happy to have this one.
That's interesting what you mentioned about Texas Instruments. You're like, okay, the price is going up, but revenue isn't going up. There's a discrepancy. That was the red flag. That's such a good point. God damn it. I don't know if I thought like that before. I think my brain just goes, let it keep going up. There's something weird. I don't know if I would have sold it based off of that, but did it correct? Did they go back down? Did the market adjust for what
It
was that?
went back down. Let me see if it went back up after that, though,
That's
because
such a good
but
note, though.
I
This is what I
know
mean.
when I sold, it was going down for a while after that, though. I
Okay.
kind of like got a good price. The point was not to have a good timing,
Yeah.
but yeah. So I sold. Let me see here. So yeah, so I sold in late 24, which was around $200. And today, I mean, it went down and went back up, but
Back up
still,
again.
right now
Yeah.
it's 185. So still was a pretty good price to get out of it. But that was more about the fact that the company was,
The
I
revenue.
mean, in the semiconductor business, the it's quite cyclical. It's what I like to say. It's like the new industrial stocks, where when there's a lot of demand, they're like pumping semiconductors and chips, and everything's going well. But then companies go to they slow down into their investment cycle. They don't want to next new big tech thing anymore, and this is when the stock price usually take a take it down, take a breath. The revenue, the earnings slowed down, but then we were in the middle of like 24 where everything was going up anywhere. So I did not feel comfortable, and I was already overweight in the technology sector. So for those reasons combined, I thought it's a really good timing to get rid of a winner position to redistribute it elsewhere and improve the diversification. Because
That's
again, I'm never sure that I'll be 100% right all the time.
yeah.
So I rather be diversified for that reason.
I love that logic so much. I am adopting that as of right now. Just that whole thought
Cool.
process you had with that. I always like that. I like that a lot. I don't know. It just for me a light bulb went in my head. I'm like, God, that's so obvious. Yeah, that makes sense. Okay, that was great. So that was STN RK number 7. This will be the last one we talk about. That is CCL, which is CCL Industries. The ticker is
Yeah.
CC-B.TO. What is this one? Why'd you buy this one?
This one is quite of a boring stock, actually. They are doing everything around packaging, like specialty packaging. Like think of products from like Procter and Gamble, for example, like bottles and stuff. They're doing the packaging for that,
That's like
and they're also doing labels. So everything in the distribution business with RFID to track your labels and stuff, they're doing that too. They're doing banknotes. So everything that can be printed, basically, that's kind of like printing business, but in not in the media or like the paper, but more into the packaging, the labeling. They own Avery, like those little small labels you put like on at the office. They own that company as well. So they grow by acquisition. They're well diversified internationally as well. So it's almost like 1/3 Canada, 1/3 US, 1/3 Europe, or something like that. It's just like all over the place. Very stable business. Been paying a dividend and increasing its dividend in Canada for, let me see here, it's more than 20 consecutive years of a dividend increase.
that's great.
So yeah, this is the type of business, just I bought it. I want to put it on the shelf and never think about it because it's super boring, but very interesting. The revenue is growing like mid-single digit, earnings is following, same thing for the dividend. So just love that type of business from time to time. It's great to have complex and exciting companies like Brookfield that we discussed today. It's also fun to have companies that are just providing basic stuff and it's just a printing money making machine.
There's a couple things there. So multiple times the companies that you've held have been growing by acquisition. Is that
Hmm.
something that you prefer or you like or you look out for? Is that something that's just an immediate, in most cases, positive sign for you? That's just something that for whatever reason you're just like, yeah, I like this. You're preferable for you in your style.
It's interesting because I came to realize this year actually that a lot of my companies are growing by acquisition. I never
Yeah.
realized that
Yeah.
before. But yeah, that's something I really love. I don't know why, but I came to that realization. Is like, yeah, most of the companies I have in my portfolio, they are in different types of industries, of course, but a lot of them are following the same playbook of, we know what we do, we're good at it, so we're just going to grow a lot faster by acquiring competitors or bolt-on acquisitions that are just making sense for us to just
To their
grow
model.
our business. Yeah, to
Yeah.
their model.
Because some companies do dumb acquisitions. It'll be a
Yeah.
grocery store chain that buys like a hockey team or something random, right? It'd be like, this doesn't make sense. Like, you guys aren't professionals in this, but they stay in their lane, right? And I think it's a good indicator of the company's health. If they're
Mhm.
able to go out and acquire the competition and all that, when they acquire them, they keep the IP of that company, right? They don't dismantle the company, do they? They just let it
Yeah.
like if they and do they keep? Do you ever look at? Do they keep CEOs intact? Do they keep management intact? Do they do a lot of cleaning house in these companies? Do you ever look at that? What they do with the
I
acquisition?
I'm I'm more interested to see what's the debt level
Oh yeah,
over time instead. So I don't really
yeah,
mind about what they do about like management team and stuff, but mostly because sometimes you have like companies that are growing by acquisition, but I mean, then you look at the long term debt trend and it goes like this all the time, and then you're just like, yeah, well, at one point you'll have to pay off for that, and
yeah,
and if you're not able to grow organically, that becomes a problem. So what I liked is to find companies that are able to do both. So a minimum of organic growth, because if you're not able to grow like 4 or 5% and you're inside your business and you're always seeking those acquisitions, at one point or another, you're going to either hit way too much debt or you're not going to find the right deal. And then you're going to disappoint the market altogether.
yeah. That makes sense. Another thing is a couple of these companies, like where we just talked about CCL Industries, but then also going back to Alimentation Couchetard, they're the unsexy companies that do the things that nobody thinks about that we all need, like the labels, the bottles, or all that stuff. But then it's like you have to get chips from the grocery store, you have to get gasoline. It's
Yeah.
like those things. I love those things. Like, that's when I felt like when I missed out on like Dollarama stuff. Like, everyone's using those things. That's the stuff that we actually. They're unsexy, but they're like there. They're like, you can't function without. You need a label for these things. Like, do
Yep.
you? create like hit lists of like companies like that, like the boring companies that keep the world running? Like they're essentially like
Uh,
the like something, and you follow those.
not not purposely. I always start with my stock screener using just a positive dividend triangle. So just a minimum growth of like revenue, earnings, and dividend, and then I go deeper into stocks. But I do feel comfortable having some of those companies lying around into my portfolio. Like, for example, I do have boring companies like Fortis that are just a classic utility
Yeah.
transmission electricity company. I have like CNR, Canadian National Railway, has not been doing great over the past few years, but I mean, it's railroads. They're literally not going anywhere. And unless we invent teleportation,
Yeah.
there's no other way you can transport goods
Large.
across Canada and across the US. You need
No
to
way.
use railroads. So those are boring, but in times of like when the market goes too crazy, it always feel reassuring to have those kind of businesses.
Your stock screener, where do I get that? Dividend Stocks Rock, or do I the Dividend Guy blog? Where can I find it?
Dividend stocks rock, but it's for members only.
Well, then
Unfortunately,
sign
we
up,
uh we
guys.
cover over like 50 companies and 50 metrics, and more than 1,200 companies now in the stock screener with full analysis.
Yeah,
So
and you guys
it's
can
pretty
download his
powerful.
you can download his free workbook as well here when you go to the website, and you can check it all of it out there. Okay, those are their 7 stocks. We went through them with Apple, Alimentation. We went through National Bank, Microsoft, Brooksfield. We went through STN. We went through CCL. Those are all fantastic, and those are your core holdings, not all your holdings in your $607,000 portfolio. I had an interesting thing. You said you could tolerate, and we'll let you go in a bit. You've been really generous with your time. I appreciate it. But one thing I want to talk to you about was you said you can stomach a lot of risk because you know you can always work more, and because you started your own business. I noticed that change because I run my own company as well. I don't worry as much about money than I used to when I used to be an employee. When I was an employee, I had fixed income. I always felt like, oh my God, if I lost this job, and what would happen because you're so reliant on a job. You remember you don't have control. It's up to the employer.
Yeah,
Like there's no
it,
lawyer. There's no
it
lawyer.
it circles back to control.
No matter what an employer tells you, like, hey, your family or whatever, they will get rid of you if it doesn't make sense. Like, they could care
Yeah,
less, right? They do not care if you're there for 30 years, 1 year, it makes no difference. And like, I feel like employment in a lot of cases is such a risk. So, like, you do need some sort of no matter what, even if it's part time, have some sort of side gig or
yeah.
something.
You need a side
That,
gig, anything.
yeah, most people do. Like, just at least in today's world, it's not like how it was back in the day. But I realized when I started my own company, obviously it's risky and you're like, oh my God, starting a business. But the financial pressure of like, wait a second, because you're confident in your ability to do your job. Like I'm in advertising, like I'm a dial now. I can dictate how much revenue I work. I can just do more
Yeah,
hours, get more clients. I could just sit there and cold call people for 2 weeks straight and lock in 3 contracts. I know I can just do that and just sit there, lock in 3 contracts, and I'm good for revenue for the next 2 years. Like it's fine, right? So like there's that lever of like, oh yeah, now my income is purely just based off of me, and luckily I'm hardworking and I understand my skill set and stuff. Is that similar to you? Because you worked a normal corporate job, you went into your own business. How was that transition? Obviously, there's the initial stress of doing something your own, but is it freeing to know you can do that?
yeah. Actually, the second I started working at the bank back in 2003, I knew that I had to work on two things. Building skills. So I can lose my job, but being employable like everywhere. So
Yeah,
I did my CFP title, I did my MBA, I learned a lot about Excels and macros just to make sure that I could dabble around. And the
yeah,
other thing is I needed a side gig. So I started blogging about personal finance back in 2006.
wow,
And then I started like buying and selling blogs because that was a thing back then, advertising, and eventually started Dividend Stocks Rocks while I was working at the bank. And the reason how I was able to finance my trip, I mean, 1 year trip, I did not save that much money. The thing is, okay, so I came back from work. I had young children. I take care of them. And between 8 to 10 or 11 p.m. each night, I was working on Dividend Stocks Rock. And for 2 years before we left for a full year. And
yeah,
then I was generating base income I mean, it was hard when we were in North America, But living in Guatemala, like it's not that expensive, so I could live off my online business. So
Yeah.
when I came back, of course, I had my RSPs and I had my pension plan, but I had no money left. I was broke, like on paper, like my bank account had like $1,000 there, and I needed a lot more to pay my bills at the end of the month, of course. And I remember I was like having a beer with my in-laws, and they were just like, "So you're quitting the bank?" And I'm like, "Yeah." And so, like, how are you gonna pay for your stuff? And I'm like, your company must be doing well. I mean, well, it was doing okay while I was living
Over
in
there.
Costa Rica, but now here in Quebec, it's going to be a different thing. Actually, I don't make enough business revenue right now to pay my mortgage at the end of the month. And they were just like, well, what you're going to do? And I'm like, well, I'm going to work very hard. That's just the whole thing, right? So at the beginning, while I wanted to build that membership website, I had to make other sacrifices. So I was writing a lot for Seeking Alpha, for example,
Oh
because
yeah.
they were paying per article. So I was trying to find side gigs that were really close to what I was doing research. I was publishing that research basically. So that research was helpful for my membership site, but I was immediately getting paid for it at the same time. So I struggled for a while, but that was how it works. I mean, as you said, you have this ability to say, well, if I want to make more money, well, I just have to work like 12 hours a day, and that's eventually going to happen.
Yep.
And I had a very deep and important discussion with my wife before I made that decision because I explained her, I mean, no more restaurant, no more going out, no more nothing basically. And I'm not going to be present for at least 12 months. Like I have to
Yep.
do that work if we want to enjoy life afterward. And today, fast forward 8 years later, it's always easier to say, right? But now it's fun because we get to travel a lot with the kids, and they all know that I will bring my laptop, and either very early in the morning or at night, I will work a couple of hours every day. But it enables us. I mean, this summer we went in Peru for 3 weeks. We went on the Inca Trail to Machu Picchu. So like 4 days, the five of us plus my son's girlfriend. So that was just such an amazing memory to be able to do that in my 40s.
Yeah.
And I do not want to wait until I'm 60 to do that. And even though if I wait until I'm 60, I'll do it alone with my wife, but not with my children for sure, because they will have their life of their own, right?
Yep.
So right now it's the time. They're young adults and I still have a teenager at home. So they still want to hang around with us. They haven't started their full life yet. But I mean, already I can tell you time is running out. I mean, my
Yeah.
oldest son is 20. Next year, he told me, like, well, I might not go with you on vacation because, like, I'm working now. I have my girlfriend and so on. I'm like, that's life, you know? So you have to enjoy those things when they are available, not if you can afford them or not. And yeah, to circle back to like the transition into having that business, I realized since then that I can see what's coming next. I have
Uh-huh.
not all control over everything, but I do control enough things. Like for example, when the market crashed in 2020 after the COVID, I was like, okay, now my major risk here is if investors don't want to invest anymore, I'm going to lose my business. I mean, it's all about helping them building their portfolio. So if they just want to go all in cash and they're scared or the stock market is destroyed because business are not working anymore, what can I do? And I'm like, well, I can double down on the content I can do. So what I did is I started doing private webinar weekly with my members to reassure them, to explain them that yes, it's a crisis, but it's just another one, and answer those questions every single week. I did that for like 2 months in a row, like
Wow.
March and April, until the market started to go back up, and then I moved to once a month. And
Yeah.
since then, I'm doing like private webinars, and those are like the most popular. I have like 500 people live every single time, and sometimes we go up to like almost 3 hours of Q&As. But I just love, I mean, you can see we've been talking for like 2 hours and a half right now.
Yeah.
I just love talking about a stock market. So like you hit me up with a question and then I'm just going to start doing something. But for me, it was important to focus on what I can control. I can control my time. I can control how I do it, what I can offer to my members. And if I can be there every step of the way, then the membership becomes something meaningful for them too. So that's how I went through that and get out of the of COVID as one of the best growth of year over year ever in the history
Yeah.
of my business.
You're running your business, you're doing stuff you like doing. Like you said, you're really involved in your membership. It's very clear you enjoy doing it. It's why you can do the webinars, why you can talk for 3 hours. Do you ever, I'm kind of thinking, I've had these thoughts a lot lately. You're like, do I even work? Like, what do I do? Because I remember I come from a normal job background too. You came from a normal job background. It very much felt like you're clocking in, you're clocking
Yeah,
out.
you have to.
Your day goes, that was the work part. Now I can go live my life. Where now I feel like I'm just doing things and I'm making money. And then I go like, and then I sometimes think, like, am I doing something wrong? Because it doesn't feel like I'm working. You know what I mean? You have to check, like, what am I doing? Am I doing something? No, you're not. You're making more money month over month. You're not. It's just, it feels weird if you come from, I'm sure if you're an entrepreneur from day one, it's a natural feeling. But for
Mhm.
coming from a corporate background like myself to this, it is very weird feeling for me to be like, I never really feel like I'm working a job. I never go like, oh my God, I never think I work too much anymore. And I do 60 to 80 hours a week. And I never feel like I'm doing too much. I just know it's work technically because everything I did made money. So,
Yeah.
but I don't get burnt out. I don't feel exhausted. I don't do, none of that's happening. It's a weird feeling. Do you ever feel that way? Like, and if you do you have a solution to that? Because I feel weird a lot of times doing what I do because it doesn't feel enough. And it's not a big, not me like, look, my life is so easy. It's like, no, it's a very weird feeling when you go from working jobs you hate or not hate, or just you differentiate between work and life, and you go work and then now I live life, to now it's all blended, and you never really even know when you're working, not working, and money's happening, and you're just like, oh, that's a good idea, and you do it, and then, like, I don't know what I'm trying to say, but like, do you ever have that feeling, and how do you deal with that?
I try to see my life into different seasons. I got that from Alex Armuzzi, actually. I've been following this guy for a long time, and he was talking about that. Like sometimes you're in this, like right now. I mean, I have like my three kids are still living at home, but I mean, one is working, the other two are going to school. My wife is working, so I'm here all day with my two dogs. And there's a limit of how long I can take a walk with them. I love them. I walk
Yeah,
them twice a day. I have to do something else with my time anyway. And
yeah,
I get the opportunity, the chance of actually being good at something that I can make money out of it. And then sometimes not that easy. I mean, in finance and marketing, it's quite obvious that you can make money doing something that you love. So I don't feel bad about that, but I know it's going to end at one point. I'm going to do something else, not necessarily
yeah,
stop working, but probably change that lifestyle. But right now, I'm in this moment of my life where I can work and I can build that money. Here's the thing. I see my business as a game. It's like for me, it's like I play Monopoly every single day, and I just love it. I love rolling the dice and taking chances and trying to see if this thing's gonna work or is that thing gonna work. And sometimes it doesn't work at all, and it sucks, you know. And and what I get to understand of all of this is it's less linear than having a paycheck. Like every summer is the time that I spend the most because I'm with my family. We're traveling a lot. And on the other side, nothing happens on the stock market. It's not the right time to do webinars. It's not the right time to run campaigns. People don't care about the stock market. They're out there having fun under the sun. So those are like my weakest months in terms of revenue. And I'm just burning cash every month. And it
uh,
used to drive me sick because, you have this thinking, oh, well, I make more money this month than I have bills to pay. So it's positive, it's good. And then you go into like June, July, and August, and you're just like, yeah, I'm burning cash. I'm like, I started like in positive, and by the end of those 3 months, I'm close. Or sometimes I go into my line of credit, and I'm like,
uh,
wow, what's going on? But
yeah.
then it recovers quickly. But to understand to ride this roller coaster, and it's normal. And that was one of the most challenging thing for me. And this year, actually, it's kind of funny because I told my wife, I'm like, hey, we're in September. And she's like, yeah. And I'm like, I did not panic this time in August. And usually
Yeah.
in August, I always get grumpy a little bit because I'm not making money even though I work. And I'm like, what's going on? But this time I'm like, oh, yeah, it's going to come. It's going to be all right. And you have to live through this roller coaster of emotion instead of having that paycheck that comes in every 2 weeks. And mind you, I really like what I was doing and I was good at it when I was a financial planner. It's just that I thought when I'll be 50 or 60, will I regret not trying to have a business? And that answer was a big yes. So
Yeah.
this is why I decided to quit and then try it out. And I'm like, well, I still have my skills, right? So if that didn't work, I could have come back to the bank anytime. So that's how I see it.
I think for me, it was I had to start my own business because I was in advertising, and in my last job, I just couldn't handle it because you're at the whim of like owners and stuff, and you're just constantly have to
Hmm.
hear their bad advice and going like, "That's just not how you do it. That's just not how you do it." And I was like, "You know what? I know how to do it. Let me just do it myself." And I was like, "Oh, I was right. I didn't know how to do it, right?" So I didn't need it to do it. I think that's kind of what pushed me over the edge. And I was like, "Oh, thank God." One thing I was thinking, so like when we came here and this is gonna be more advice for like how do people make money, how to become entrepreneurs, and we're kind of getting to a different conversation here, and I'll let you
Yeah.
go in like 5 minutes. I swear to God. But it was when I turned on the lights here, came down to talk to you. I'm in the basement of my house, so everyone knows this. I have my wife, my kids are upstairs, so I don't rent out my home. My whole basement is I have two one-bedroom suites. One bedroom is for guests, right? So like my mom and dad visit me a lot, so they have a suite, and then my second suite is my office, right? So I have everything I need here. I got fridges or whatever. I can go lay down, take a nap if I have to, and then the upstairs, my wife, my kids are just running around. So everything is my world is in this unit here, and I got my dog, right? And I said, and I just kind of thought, I'm like, everything I built, everything has just been in this exact spot you're looking at, in this chair, looking at this exact computer, and that's all it's in. Like, it's like, what's the
That's
point of
amazing.
this? It's just you just and the reason why it hit me was because I was talking to a potential client yesterday, and they're saying, "Oh, are you gonna go fly out to this event, right, and go meet everybody and all this stuff?" And I was like, "No, I'm not gonna go anywhere. I'm not. Like, why would I go there?" They're like, "Well, you're not going. You're not going." I'm like, "No, like, why would I? Like, I got young kids. I don't want to leave them. Like, I've phone enough in my life. I'm like, I don't need to. I don't have to go anywhere. Like, oh, it's just in Portland or something." I was like, "I'm not going anywhere unless I'm sitting in this chair." And they looked at me like, "Okay, And this is like a major, large company that you might see in the future, and like a head person there would be like, "Never heard that before. This guy's just saying no to stuff." Because I'm like, I realized like I don't have to travel. I don't have to do shit. I just have to sit
Yeah.
down in this chair, use my brain for a lot. Every once in a while, make a YouTube video about what I already know everything about. But for the most part, I'm just running an advertising agency, which requires me just looking at data all day and putting together, these elaborate campaigns, which is just sitting here and not moving for extended periods of time. Right. So no social media, not answering my phone, and just sitting here and I have music playing. That's like all I do. And it's like, how do you get successful? Don't move, remove distractions,
Yeah.
and then just sit in that spot for when it comes to computer stuff for extended periods of time. Obviously, it's manual labor or something. Do manual labor for extended periods of time with no distractions and try to scale up. But like
Keep the focus.
that's the key to success, though. It's like
Oh, yeah.
extended periods of focus with no distractions, right? And just do the goddamn thing. Pick like one task that sucks, like your least favorite task that you have to do, and get that done first. Because the reason why you're probably stressed right now is because you haven't done that thing.
Yeah.
It's like
Big
your
time.
stressor is your stressor is like, oh, I don't make enough money and I just launched a business. That's a stressor, right? Okay, great. And you have no leads and you have no connections and you have nothing. Did you put together a cold email marketing strategy and you're going to email 50 people today? No, we'll do that first. Did you pick up the phone? Did you pick up the phone and start calling people? No, do that. Did you reach out to all your friends and let them know that you have a new business and see if you can get business that way? No, go do that. Start and sit down and just do it and then move on to the next thing. You'll notice your stress is gone because you're now actively solving the problem. And you'll notice you do that for 3 months. You're like, oh, I'm now generating money.
Yeah.
I, I,
That
I
is so
realize
true.
I realize building a business and doing anything is like there is no secret formula. There's nothing. It was just that. And I think that was a stress relief because that's when we talked about, oh, I can make money anytime I want. I just do more of that.
Hmm.
And then I have more money. And then that's it.
And what I did on my side to help me keep that focus is to identify maximum 3 critical tasks per week.
That's right.
If I
Yeah.
can nail down those 3 tasks, this week has been successful. And then you have like a whole bunch of stuff, but you just say, where am I adding value? Where am I creating something that will continue to walk along me for the next couple of weeks, couple of months, and generate something? You do that first. And most of the time, as you mentioned, like you do the cold calls, you do like that email marketing campaign that you have been like postponing for a while because it requires research, and then you need to write stuff and you need to think about it. Well, this is what's going to pay for your mortgage at the end of the month, so you might as well get started working on that. And you know, when I started as a financial planner, I got that advice from one of my mentor, and he's like, you know, it's all about the numbers, right? So if you make one call a day to a client, you may or may not get you may or may not book an appointment, and then you may or may not close that deal. If you do 10 calls, you're going to have probably 2 appointment, probably 1 deal or not. But then if you do 50, well, you're set for the week, and then you're set for the month. And just a matter of like picking the phone and doing those 50 calls. And if you do that, all the other, I mean, it's really you are in marketing. I mean, it's just all those percent conversion rate. Like a call will convert to a discussion, the discussion will
Yeah.
convert to an appointment, the appointment will go to a deal, and eventually it's going to go to a referral. But if you don't do the first thing, it's not going to work. Same thing with my business. If I don't do those YouTube videos, or I don't write those newsletters, or I'm not on social media or do a podcast, well, nobody will hear about me. They will not sign to my newsletter, and they will not sign up to Dividend Stocks Rock or Retirement Loop at one day. You need to get those things going all the time. And instead, and I told you off the record before we started, that I coach young kids at soccer. So it's pretty good level. And this year was really tough year. Like they're U13, double A. We did not win a lot of games. At first, we were like 2 wins, 12 losses. But I told them the results doesn't matter. It's the process, is how we play, and eventually how we lose. There's a difference. And by the end of the year, we ended up with a positive streak, like winning games, and with all of that, advancing in the playoffs, like winning playoffs round as well, just because they followed the process the entire 4 months. So at first, doesn't seems like it's working, but you have to trust the process, and you just have to go do those reps. And the more you do, the more you're going to become successful. And that's true for your business. That's true in sports. That's true pretty much in everything. But the process, sometimes it's daunting, it's demanding, and it's boring. But this is what you have to do. You just have to trust it, and then you just follow it up.
Success is boring. What
Yeah.
one it is, it's true. It's really just, it's all the stuff that no one's looking at. Then they see a YouTube video of, look, I made $1 million in 1 year. It's like, well, it was really boring to get to that. One last note about this is just because I've been thinking about this, was I think about this every once in a while. I go, I wish before I started my business, I started sooner and I didn't do so much pre-planning. I had some paralysis by analysis. Before I started my business, because I watched so much YouTube content and stuff on it, I was like, okay, I need the products, I need the infrastructure, I need all this stuff set up. But then when I started the business to where I am now, I worked hard, which is good. But like, say I had 10 products. I'm now only selling 2 of them because I just dwindled away to what people like. I got the testing really. I'm like, no, people only want these 2 things. These are what really move the needle. The things that grow my business, I had like all these different things I was doing, and then now I have like 2 things that actually move the needle. And then like all these things, how you manage internally, how I manage my employees, everything is like, it's dwindled down to now only a couple actions now are like, say 20% of the work is providing 80% of the value now.
Yeah.
I've got to that golden ratio.
Always.
but everyone's is going to start with a bunch of shit, and it's like you have clay. And with a business, I find you're not building something, like adding to it. What you're doing is you're taking clay and you're chipping away at what you don't need until you get the image you're looking at. And I think when you take that's mentality, I wish I had a little bit more. If someone told me, I'm like, no. You start with everything, and luckily I realized really quickly, because I come from advertising, this is test and iterate. So I wasn't married to any ideas. I knew I had to strip away, but I wish I started sooner so I could start doing the strip away process even faster. Because now my company is from day one to day now, it's like night and day different, not even the same thing. I'm offering all this different stuff. How I manage it is differently. Everything is differently. It was just chipping away until I got this now clear image of what it is, and it's refined. I'm not wasting time on things I don't need to do, but you don't know until you start and figure out what you don't need to do. Because let's say one lead generation method for my business might work great, but might not work good for you. And what worked good for you, but you have to test it and try it all.
Yeah.
So I feel like for most people, if they're trying to side gig or starting a business, just start it, see if there's demand, and see if there's demand. Give it away. Be like, does anyone even care to have this? Like, ask your friends, you want to use, like, see if there's demand, and if there's demand, then like build around it. Like, that's just like a quick tip I have for people. I just want to say that because I don't know, I just wish I had a little bit more that I knew that, understood it. I would have started sooner, started testing sooner. Yeah.
You know what? When I started to work full time for Dividend Stocks Rock, we that was like in July, and then in September I did my first webinar. And I mean, of course, it was just okay. Like, well, I got success and stuff, but I was not proud of like what I delivered in terms of like the tech, the sound, the lighting, the performance, and everything. And then my best friend said something. He's like, Mike, you're better than 97% of people. And I'm like, what do you say? I mean, I'm like, that webinar was barely okay. And he's like, yeah, well, only 3% of people are doing webinars. So you're definitely better than everybody else. So you don't have to be perfect. You don't have to plan, as you said. You just do it. And then I became better. And then I have like this entire studio now. My desk is moving. I got those mics and stuff. But at first, I was just, press the damn record button and then just go on. And then you're going to learn from that. And stop thinking, just start acting. And it's going to work. It's just going to work.
I was talking to somebody else. I'm always trying to like motivate people I know to start YouTube channels. Be like, if I know someone has a skill set, I go like, start a YouTube channel, just start a YouTube channel, right? But then I always think about this, and I got this from someone else, is if you're someone who's always actively trying to learn from your experiences in your work, and you work really goddamn hard, so you do something, you go like, how do I improve? And that is your method to everything. You then have to understand that the version that you look in the mirror of yourself, your bank account, your business size, your YouTube channel, even your health, the worst you will ever be is right now.
Yeah.
And for most of us, right now is pretty good. Like, I'm not, and most, like, even if you're in debt, even if you're like a good person, you're hardworking, God damn it, right now is really good, regardless of your bank account, whatever, if you got that in you, because you know that like tomorrow's even better, and that'll be the worst version of you that you'll ever see. It's like, what a weird feeling to be like, right now, me and you talking, this is the worst versions of ourselves that we're going to see. This is our worst.
I like that. I like that a lot.
Yeah. All right. How about we end it there then? You just talked to the worst version of Mike, the Dividend guy, and Gary Gill. Thank you so much for talking to me. And we'll talk soon, man. It was great.
Gary, it's been most of a pleasure. Thank you so much.
Talk soon.